Right on. So welcome everyone to another Saturday session, the oil and gas macro outlook today. Once again, appreciate everyone joining us. Been a very interesting week in the markets, month really. We're 4 months into 2022 and looks like things are going well. I think WTI is averaging just about $100 a barrel so far this year. So lots of noise out there amongst all the data, lots of bad data, bad interpretations of the data. So I look forward to kind of sharing my opinion and my insight into what I'm looking at. Just a few things up front. Everything here, I'm not an investment advisor, so everything here is my So everything here is just my opinion. So please do your own due diligence, check your own portfolio risk tolerance, what kind of returns you're expecting from the market. The oil and gas industry has been known to be very volatile, and we know that to be the case even today. And the session here will be recorded. It will be published on the website here later today. The previous sessions, along with the company valuations, are also recorded and available on the website. We do have our price targets out. They will be updated as we see Q1 results rolling in, really, really good results. And they will be updated as we go here, as more and more come out. And I'll leave the chat open to questions on the Zoom. For anyone on the Twitter Spaces, we're gonna have no audio on the Twitter Spaces for the speakers. It's gonna be strictly audio only. So feel free to please join the Zoom if you have questions. And if you want to have a look at the visuals. And once we're done with the Zoom call, we will move it onto Twitter Spaces. But as what happens every week, I get a lot of questions on these macros after the fact. And I ended up doing some research and adding a few slides. So yeah, this is going to be a long session. So I think we'll take probably a break in the middle and then continue on. There's kind of two ways. I've been thinking about having like a smaller session that just highlights the main things, like a 30-minute to 45-minute session. So I might start doing that, and then move these long macros, like 4 or 5 hour macros, to every 2 months. But I will keep everyone updated. So other than that, yeah, we'll get started. If there's any questions, put them in the chat, and then we'll kind of go from there. So similar setup to all the other sessions. We'll start with the pricing, how things are looking, how things have looked. And then we'll look at the macro, the only 3 things that really matter in my opinion, which are inventories, demand, and supply. If we can have a good handle on where these are and where they're going, it helps the conviction of the trade and not getting panicked out, not feeling the volatility. I heard the other day somebody was unable to sleep at night because of the movement of these oil and gas equities. So yeah, I think having a good handle on these and looking at the longer term zoomed out picture changes things a bit. It doesn't make anyone fully comfortable, but it does help a lot looking at the data and what's happening rather than the headlines and random news out there that's designed to sway and get clicks and whatnot. Okay, so we'll get started with the WTI chart. So 105, I mean, that is phenomenal. We often forget here, people in the oil and gas trade, at where we used to trade and where we've traded for the last 5 years. For pretty much the entirety of the last 5 years, we were under $75 a barrel. So we're now $30 above that. And there's been some wild movements, but you know, despite all the headlines, despite all the COVID stuff and whatnot, we're still above $100 a barrel, and pretty comfortably so. It's not like we're dipping into the 90s for very long. It's maybe a day or excuse me, a day or 2 or 3, and then we're right back above $100. So from that standpoint, really great place to be. And then natural gas, obviously the widow maker, the one that everyone thinks they can predict, but no one really can. We had this big spike last year and a drawdown. Nobody thought it could stay. Oh, excuse me. Nobody thought it could stay above $5, $6, but here we are, and it's above $7 and staying there. It fell below 7. We had a lot of people taking victory laps, and we're back above 7 pretty consistently. And looks like the supply of natural gas is becoming a concern now, just like the supply of oil was. So when we look at the Canadian pricing, we got condensate. I always like to refer to condensate because it's becoming a bigger and bigger share of Canadian production along with WCS. So when we look at condensate, it's still trading at a couple bucks above WTI. I think this chart is a little bit older, so it's not showing that, but really, really great place to be for the Montney, the Duvernay players, which are the big growth players at this point in the Canadian verse. And we look at WCS. WCS is above 90 bucks a barrel. It was above $100 a barrel there for a bit. And anyone you would have said that to in 2020 or even 2021 would have called you crazy, really. So great place to be on the Canadian side. When we look at a 10-year chart, we're pretty much at the top of the range for WCS pricing, where we were in the 2010 to 2014 days, right up above 90 bucks a barrel there. And I think this data only goes to January, I'm not wrong. So looking great. And what makes it even better, and something that a lot of people have discussed but also gets missed often, is the impact of the exchange rate. So back in 2010 to 2014, WCS was at $90 US here on the top chart, which is roughly $90 a barrel Canadian, because the dollar was at par. These days, it looks like the Canadian dollar is hanging around that 1.25 range. So $90 WTI US per barrel, or WCS US per barrel, ends up becoming like 115 Canadian dollars a barrel, and that all goes to the top line revenue and into the bottom line profit. So there's a built-in 25% bonus there, and it doesn't look like it's going away. Usually with higher oil pricing, we would see the Canadian dollar get closer to par, but it's just hanging in there despite how strong oil gets. And then the strength of the US dollar is something that's been discussed a lot. So that obviously is also helping keep this relationship at that 1.25, and it seems like it's going to stay that way, if not get worse, as in better for Canadian oil producers, worse for the dollar itself, I should say. We look at Canadian gas pricing. It's been on an absolute tear. So we look at what the prices were about a month ago. We had a $4 strip. I think the last time I did this macro, we had roughly a $4.25 strip. We're now $6.50. So things have changed a lot in the natural gas space in the last month. I think people were overestimating the supply and did not realize how much natural gas demand is going to go up, or is going up, within Alberta specifically as well. It's going to be strange to hear this, but Canadian natural gas production is at record highs. It's already like 4 or 5% above the highest we've ever had. So the fact that we're in a supply crunch with having record production bodes pretty well for this Canadian gas going forward. I wouldn't be surprised to see $6 AECO plus for all summer, and going into next winter, depending on how the storage looks. I mean, we could be looking at $7, $8, $10 AECO all winter long, especially if it's a colder winter, which that's why they call it the Widowmaker. So yeah, pretty interesting times. On the European gas, probably the one market that's pulling everything up. They're looking for as much gas molecules as they can get, literally. So the higher European pricing has pushed up the American pricing, which is requiring America to import more gas from Canada, and thus pushing the Canadian price up. So natural gas has definitely changed. It's become a more globalized market, which I think a lot of people are ignoring for some reason. But natural gas used to be very localized markets with their own supply demand. But with it being globalized, the pricing power is here to stay. I don't think you're going to see these wild drop-offs into negatives and money losing prices anymore. But again, just my opinion. When we look at the TTF pricing closely, about a year ago it was $20. I think this is euros per megawatt hour is what ICE uses, and it's staying up here in this 90 range. It's been up here for just about 6 months now. So looks like the market is here to stay. There's been a lot of subsidies going around in Europe, so that's definitely helping the price. And this is 2022, winter 2022. It's been often discussed, the pricing power, that how much can European gas really stay up here? Well, let's look at 2023 here, winter 23. I mean, it's higher than it's ever been here. It's even higher than February when the Russia-Ukraine incidents first happened. So, when we look further out into the curve, into the strip, we see what's really happening behind the scenes. What are people looking at for the longer term pricing power of this? And winter 2023 is getting bid up to very, very high amounts. Look at calendar 25. The 2025 European gas has gone from 16-ish to 49. It's tripled, and it's staying there. I mean, look at calendar 25 and February and the impact of the invasion. Nothing really changed in the 2025 strip until now, and people are starting to realize that this is a longer term issue than just a 1-year problem where you jam a bunch of LNG ships in and you fix it. That's not going to happen. So why do I mention TTF over and over? Because this is the market that's going to push the Asian market up in terms of LNG, which is going to push the American Henry Hub pricing up, and it's going to come back to the Canadian AECO pricing. It's all linked. So I think we need to start thinking about the natural gas markets as being linked. They're no longer their own system anymore. And I think a lot of people are going to get caught off guard here with thinking of the Canadian system as its own system, which it has been forever until now. So just something to keep in mind from my side. When we look at oil inventories, basically inventories tell you the main picture, which is what's the difference between supply and demand. There's a clear indication of what's going on over the last year. In 2021, we saw roughly 1 million barrels a day in global crude inventories come down. That was the supply demand imbalance. This is by year. This is in a cumulative fashion. So you can see the draws that we've been getting have been unlike anything else before. So, we look at 2008 here, where nothing was really out of whack here in the supply demand of what was going on worldwide, which is why a recession caused such a massive drop in the price of oil. Well, look where we are today. We're in this steep drop off in inventory. So even and I'll talk about this later, but even a recession that chops off demand may not be enough to bring the supply demand back into equilibrium. So just keep that in mind. I don't think we can refer to everything as just an 08 situation over and over. That's pretty lazy work in my opinion. So I think these graphs paint a better picture of what's going on right now in world oil supply demand. We look at that same graph into 2022. Things have changed a bit. We had this continuous draw start in February, March, and then China shut down. We had Russian oil staying on the market and some other issues, with February being a low demand season. So, the crude number seems to have stabilized, and that's what everyone has in mind right now. But look at the last 7 to 10 days here. We have again gone back into this supply demand undersupply again in the last 7 to 10 days. Something has definitely changed. So worthwhile keeping an eye out on this. When we see a big drastic reversal in the trends, it's usually indicative of something, and lets you get a front running view in a way of what's going on. So this is the latest Morgan Stanley report as of April 25th, I believe. So it's already about a week delayed. And if this trend continues to go down at this point, I think I will be very confident in my oil equities. I have bought a lot of positions in the last week or so, just based on this data point, where we see this reversal and a big difference happening between what the data is showing and between what the headlines are showing, which have usually been the best investment opportunities in the past. So we look at the Delta wave, we look at the Omicron November issue, et cetera. Those have been the best opportunities when the data is showing that the undersupply is back, but the headlines seem to keep pumping out this negative news. The same data here is verified by Goldman Sachs using their inventory tracking. The only place where inventory is higher than it was pre-COVID is in China, because they loaded up a ton of crude, took advantage of extra crude that was available for cheap in 2020 and 2021. So now they're slowly draining that down. And I don't have the latest data here, but I would say that the latest data would show that China has actually drained more of their inventories here. But yeah, I will look forward to that data. So one of the pushbacks I was getting was, well, crude is dropping, so oil, but what about products? You could have crude dropping, but the products building, products being gasoline, diesel, jet fuel, etc. But when we look at the crude oil and products graph, we see that we're actually draining about 2 million barrels a day. So what that means is we were draining throughout 2021, we were draining about 1 million barrels a day of crude and an additional 1 million barrels a day of products. So that was a running number that was used throughout 2021, was about 2 million barrels a day of undersupply. At a time when demand wasn't even really back fully, a lot of countries were still shut down. So I think a lot of people often forget this fact that we're sustaining at $100 a barrel with a lot of demand yet to come, and I'll talk about that here later, and why it's just going to get the market tighter and tighter, and where we kind of go from here. So this is again the top 20 countries outside the US and their inventories. So this is not just a US based situation. America has the most transparent inventories, so it's easier to figure out what's going on. But it's important to verify it with the world data and see what's going on from a worldwide situation as well. So again, 1 million barrel a day crude, 1 million barrel a day product. That's the number we're running with. 2022 has been a bit slower decline, but also Q1 is usually the lowest demand season. So just keep that in mind as well. The demand is not just constant throughout the year, it does change. Summer is usually much higher, so we're kind of going to see the impact of this and whether the system can maintain the brunt of this impact. Looking at America specifically, it's just down. Like the whole chart is, all the inventories are just going down. This is 2021 here in yellow. This is 2022, and the slope has gone even worse. Part of the reasoning being that America seems America seems to have this thing where they want to release SPRs to get votes, which is, again, I'll talk about that here as well, but America's oil inventories are draining very fast. This is not a sustainable slope as we go into the rest of the year. Look at the same thing on a cumulative graph, and it's just fallen right off a cliff. I think we're down to 1700 now, so even lower here. And there's no sign of stopping. The supply demand within America has gone completely out of whack. And there's a lot of factors that are causing that. So within the crude itself, American crude with the SPR is the Strategic Petroleum Reserve, which is to be used for earthquakes, hurricanes, any big supply loss. And I think we should be adding that into the total US crude storage. So again, straight down, we've fallen below 1 billion barrels a day, or 1 billion barrels of storage for the first time in, I want to say, 10 years. And where we are right now is, I think, lows till 2005. So we're falling pretty fast here. And you can ignore this data until you can't. You know, it's like a savings account. You can keep draining the savings account, and then a big credit card bill comes due, and all of a sudden you're caught there. You know, kind of like a deer in the headlights. So as people realize this, it's going to become more and more a concern, and I think the oil price is going to reflect that, the perceived shortage going forward. So when we go back here, compared to the 5-year average in 2010 to 2014, which is this light blue line, we are roughly over 100 million barrels below that already here in terms of available crude. But the one thing that's changed since 2010 to 14 is there's been a lot more line fill that's happened in the US. So what does that mean? That means that there's a lot more oil that's physically in the pipelines that they've built since 2010 till today. This oil is required to keep the system running. You can't just pull a barrel out of a running pipeline. It needs that minimum pressure in there. It needs that minimum volume in there for oil to continue flowing. So there's been about 50 million barrels of line fill added in the last 10 years. So when we go back here, we're at 100 million barrels of storage below what we were in 2010 to 14. We're actually 150 million below that. If you look at actual usable crude, you know, not just the raw number of crude out there, but the actual physical crude available for purchase, available for refining. Again, a lot of people just keep ignoring these facts, and they say, "Oh, we're fine. You know, we got plenty of oil here to go." Well, you want to be careful with how low we drain this savings here. You know, if there's a big hurricane this summer that knocks out the Gulf of Mexico again for a month, we could get really, really tight on the actual storage of crude available to use. The same way we saw negative pricing when people were not able to store barrels at Cushing, you know, we could see the opposite of that, where there literally is no barrel out there to give delivery to the Cushing contract. So I think it's important to keep these things in mind, and not just ignore them as, you know, times have changed, we don't need the storage anymore. All these arguments make sense until they don't, and the markets come back to reflect the reality of a shortage. This is the SPR. This is the Strategic Petroleum Reserve, to be used in case of wars, in case of any big issues with production, and it's just being used as some sort of free account that you just keep draining oil from, and it's become a political tool more than it has a actual savings and emergency reserve. We see about since the start of 2021, we're down almost 100 million barrels already. So in about a year, we've drained 100 million barrels. So that's over 2 million barrels a week that America has been subsidizing the world through their strategic reserves, as they call them. Is it going to come back to bite them? I believe so, but we'll we'll see how this plays out as it goes. This is the same chart on a cumulative scale. By the end of May, well, right now we're at the lowest level in 20 years since 2002. By the end of May, we'll be at the lowest level since 1985. Since 1985, the American oil production is actually relatively similar as it was back then, but the consumption has gone up considerably. So again, how low do you want to keep draining your savings account? And for now, nobody cares because the market doesn't really understand these things, and they say, well, oil can sustain here, but once this insurance policy leaves the building, could be late this year, could be into next year, what's going to happen then? This is not a replenishing source, like a fresh water or something like that. This is physical oil in the ground. And the SPR has a lot of issues as well. As we drain this to 40-year lows, some of the issues will become more and more in the spotlight. Does this oil have a bunch of H2S in there that can't be processed by refiners? Are the caverns even physically able to push out this much oil? Are the caverns going to collapse on themselves? These are old salt caverns that they've pumped this oil into. They're artificially man-made. So it'll be interesting to see how this goes. A couple of years ago, some of the oil that was taken from the SPR was returned because it was contaminated. And that was the freshest oil that they took from the top. So as we drain this further, you get to the oil that's been sitting in there for 40, 50 years. Is there going to be a lot of heavy metals in there that have come to the bottom? Is there going to be other issues? We don't know, but the market has just taken this for granted that this is fresh oil sitting there. I don't think so. I think there's a big asterisk with this oil. As we go below 500 and 400 million barrels, there's going to be a big question as to whether this oil is really good or not. There's a comment here that the infrastructure is apparently shot to hell. Yeah, I totally believe that. Like this, they haven't really maintained this because it's been basically flat for a while. So all the pumps, all the tanks, all the pipelines, were they actually checked? Were they actually maintained? I don't know, but I would bet that they aren't actually maintained to what they should be. When you aren't using a pump for 6 years, sometimes they ignore the maintenance and repairs, especially when the oil prices are low and they don't have money to pay for these repairs and maintenance. So yeah, great point. Let's look at products in the US. Down. It's sitting well below where we should be. The usual build in Q1 happened, but not really to the same extent. And we're heading into summer driving season. We're heading into big diesel usage season with the farmers, big jet fuel demand season, and sitting very, very low already. So it'll be interesting to see how far this can go. We had a diesel issue, I believe this week, in New York, where they didn't have any barrels to give for the contract. So are we going to see more and more issues with products and not having the right products available to meet demand? Again, one to watch for. People just say demand destruction is going to happen, but again, that's lazy reporting. I believe it's going to be distillates where you're going to see the most demand destruction possibly, but distillates are also the one that are most needed. You can't really just stop using diesel and trucking stuff and using them in your farms. Gasoline might be more possible of demand destruction at very high prices, but gasoline is also not the one in shortage. It seems to be distillate and jet fuels that are the ones in shortage. So I think it's worth doing a deeper dive into these things and looking at where the demand destruction is going to occur. Gasoline in the US is roughly a 10 million barrel a day market. Distillate is only 4. So, 4 to 5. So if you're saying that there's going to be a 10% demand destruction, it means way different things between gasoline and diesel and jet fuel. So keep an eye out for the data. look for actual sources of data that are doing the work and giving you specifics, not just X is going to happen because of Y. So just my opinion again. So we see U.S. gasoline, like I mentioned, it's low, but it's within its 5-year range at least. Drawing very hard though, and we'll see again how low this can go. This comes at a time when gasoline demand isn't even really that high. We haven't seen the big summer uptick yet, which comes usually around Memorial Day. So we'll see how this goes here. Distillate, compared to gasoline, look at how low distillate is. It's about 10% below the lowest it's been in the last 5 years. So a much tighter market in distillates, very low. Jet fuel, I don't have an updated graph here, but we're roughly at 36 million. So take week 16, plot 36 million in here. Again, we're 10% below, going into possibly a very high summer jet fuel usage season. So sitting low everywhere, there is no safety net left. It's not like crude is drawn and products are building, so you have a bunch of excess stuff all over the place. We're low in every type of crude and product. So in terms of pricing going forward, you have to normalize inventories first before the prices are going to fall a lot. So I think anyone talking about $30 oil or $40 oil in a recession, it just doesn't make sense. Which sort of data agrees with that? And I would say none at the moment. Propane. So again, America has this thirst for exporting everything. They seem to want to export all their oil and all their extra propanes and everything to subsidize the world, which is great. So production of propane has gone up from 900,000 barrels a day to roughly 1.8, so it's doubled in the last 10 years, and they basically exported all of that. There's some huge export terminals coming in for propane and butanes and stuff, which are just all going to get exported out as we see propane usage going up in countries with emerging markets, because they use them for their cooking, they use them for their heating needs and some other stuff. So the demand is there for it, and America is exporting everything. Propane inventories, record lows. They're sitting below the 5-year averages, below the 2015 to 2019 averages. This is not an updated graph as well, so I believe it's roughly 40 million right now. So not great. Again, sitting very, very low on the propane. Let's look at Canada. Inventories are very low to their operational range. We basically have hit the lowest we can physically hit, because this minimum amount of oil is required to keep the tanks and the pipelines and the refineries and whatnot going. And we're basically sitting right there. So again, it's not like inventory is building up in Canada. It's either. We are sitting very low. Every barrel of oil is getting sent to the US because they need it. I will answer your question here, Anders, later on, if you wouldn't mind asking that in a bit here, once we get to the production section. Saudi inventories. So this, I believe, includes inventories within Saudi Arabia and Saudi-owned inventories in other countries. We had this massive build throughout the 2000s until 2015, and we've been drawing big time since then. So basically the entire excess is gone. So the US still had a bunch of excess oil, you could say, sitting around as a safety net. Saudi is completely out. They seem to have hit their operational minimum as well here, where they are, because it really hasn't moved in the last 18 months, which is again very interesting. There's no Saudi Arabia extra oil sitting around left for the world to consume. They're basically sitting here, and about a month ago they even came out in the news and they said, we are not responsible for the for any issues arising with oil supply, if there's any attacks or anything like that. So, why are they saying that? Because they literally don't have the supply in case they have another incident, which are getting more and more. We look at Fujairah, which is in the UAE. It's a big hub for the middle distillates and a bunch of ships. Heavy distillates are low. Light distillates, there's basically nothing left. Middle distillates, which is your jet fuels and diesels, I believe, there's basically nothing left. So it's not like there's inventories building in the Middle East either. So just keep all this in mind. It's not just America. It's Saudi, it's Canada, it's the UAE here. Singapore, there's literally nothing left. We have drained inventories like 70% in the last 18 months. And Singapore is a big hub for a lot of ships go there as floating storage. They do ship-to-ship transfers. So it's a good proxy as to the overall floating storage excess that's out there. And the answer is zero. There's basically nothing. And it's not building either. It's at the lowest and it's staying there. Which again, I think this is the operational minimum required. They need to keep some minimum there to meet contracts, to meet the port's requirements, et cetera, et cetera. So there's no excess at all here. So running on thin ice pretty much across the world. We look at Chinese inventories. Very hard to get accurate numbers on Chinese inventories, but you can kind of see what's happened. They built up a bunch of crude during COVID. Then they started draining it. Some of their biggest refiners were all out of this excess crude. Some of these smaller refiners do have it, but some of the refiners were going into a negative. And this graph is already 6 months old, I believe. So it's not accurate at all, but it kind of goes to show you that some of the Chinese data that was coming out on their weak imports were because they were draining inventories at such a rapid fashion. So that's why I say that inventories are probably the most important thing, because they tell you exactly the difference between supply demand on a rolling basis as you go. So yeah, the latest on Chinese inventories, there was all this talk that Chinese inventories are going to be building with the Shanghai shutdown and whatnot, and the data doesn't agree with it. And again, a case of the data telling you wrong things, or the headlines telling you the wrong things. Chinese inventory, this is 2021, in yellow, was drained to some sort of level here, and it's basically stayed at that level, plus or minus 20 million barrels for the last 4 months. So there has been no random massive build in Chinese inventories. They are right where they are. There was this thread going around that China was buying inventory cheap, and they kept trying to jawbone the price down so they could load up. Maybe they have loaded up and the oil is on the ships still waiting to unload in China, but it's been about 2 months since the Ukraine-Russia conflict started, and nothing major anyway. There's been a build, but nothing crazy, especially when taking into account that the China has been locked down and a bunch of flights have not been going, et cetera, et cetera. So pretty great. Product inventories worldwide, the distillate is where the problem is. And, we look at light distillates, middle and heavy. They're all very, very low, especially the middle distillate, which is again, your jet fuels and your diesels, are extremely low and dropping very fast. So something to keep in mind as we go here into the summer season, you're probably going to see the issues occurring in the diesel part of the world, which is a benefit to oil sand producers, because refiners are going to have higher margins to produce heavier products and not just straight gasoline, which means the demand for heavier oil should be higher into the summer compared to the sweet light barrel. So what does that mean? That means the WCS differential into the US should stay very tight, especially with the heavy oil supply being more and more dwindled. So, I think it's very important to think of things this way as opposed to just an inventory issue. When we see a shortage in distillates, that's how I'm thinking about it. Is okay, the oil sand producers are set to benefit this summer and into the fall, due to this diesel issue here. We see other is building, which is your fuel oils and asphalt and whatnot. I don't think it's that important because they build anyway. But again, one to watch. It's been building at a very high rate, which may tell you that the world is setting up for a pretty strong road construction season or some sort of other construction season. One to watch. Again, it doesn't mean anything right away, but you can make these predictions of what's going to happen here, and why they're building up a bunch of asphalt and road oils and fuel oils and such. Floating inventories worldwide have again normalized back to our pre-COVID levels. A lot of the build was in China, which has come down to their pre-COVID levels. Again, this is an older chart, but I can tell you that the floating storage has not changed from where it is here today. So storage is not building on land, it's not building on America, it's drawing in UAE, in Saudi, in Singapore, and the floating storage is drawing as well. There's no excess left in the floating storage. So oil on the water is the other one. Oil on the water is how much oil is in floating storage plus the total oil on ships that are transporting oil. So what happened when the Russia-Ukraine conflict started? They started pumping a bunch of oil onto ships for longer term, longer voyages. So instead of going just to Europe, they were going to North America, they were going to South America, Asia, possibly India, China, and a bunch of oil started getting accumulated on these ships that were having longer vessels, longer voyages. But the crude oil and water has again normalized. So we look at from February's high to April 25th, we drew roughly 60 million barrels of oil on the water. That's 2 million barrels a day that we were drawing from oil on the water, that nobody's talking about. People seem to keep talking about American storage and Chinese storage and Indian storage, and they're going to do this with the SPR and that with the SPR. Well, the oil on the water has come down by maybe not 2 million, maybe 1 million barrel a day roughly. And it's normalized. It's back to the normal zone here. So once that 1 million barrel a day stops, that's another impact that people are not really focusing on. But to me, the oil market is tighter than it's ever been, and the headlines are projecting some sort of different understanding of what's going on. But to me, oil is drawing worldwide. It's still drawing at an alarming clip, at a time when demand has been artificially cut. So what's going to happen when Chinese demand comes back online, when jet fuel demand comes back online, when the summer driving season starts? That's what I'm thinking here, and why the short-term noise in the market with equities dropping 5% or 6% and then rebounding, the market is telling you what's really happening. They are not able to keep oil in the $90 range for more than 2 or 3 days. What is that telling you as to how the perceived shortage is being perceived into the summer and into the fall? It's totally different than what the headlines are telling us. Iran's floating storage is being cut by 20 million barrels. So this is condensate, gas condensate. And Iran itself is having to pull from their floating storage. Again, what do headlines like this tell you as to what's going on in reality? Not what Joe Biden or whoever else is telling you. So On the inventory side, I'm not the least bit concerned. In March, a lot of the headlines had me spooked that what's going to happen here. If Russian oil stayed on the market and China shut down, there's people panicking. So I decided to really look deeper into the data and see what's the inventories actually telling us as to what's happening. And nothing's really changed on the inventory side. In fact, it's a bullish catalyst with all the reopening trade that's again going to happen in China. And we know how much oil China consumes. Just Shanghai, to be honest. Jet fuel worldwide, very low. I keep repeating the same thing, but basically there's very little jet fuel out there. We saw shortages already. Vietnamese crude is trading at a very high premium to Brent. What does that mean? That means, in my opinion, that means that the supply is low and the demand is high. The buyers are willing to pay much higher pricing, even compared to dated Brent. So if that's the case, inventories in Vietnam should be drawing as well. That's the conclusion that I'm coming to, based on the spot prices being so high, and the differentials being so high to the worldwide benchmark. This is a very interesting graph because the EIA, which is the US agency that's most relied upon to provide data on oil, has been completely wrong. For the last 18 months, it's been completely wrong, embarrassingly wrong. So people tell me that, well, look at this, American production is going up. Well, look at this, American storage is going to start building again in Q2. It's going to start doing this and doing that. Well, this data is so wrong that it's just hilarious that they keep pumping out the same thing month after month. I would bet very little work goes into putting these together, and they just jam out random predictions as to what's going to happen. We look at March, they predicted flat, it kept drawing. Just in March 2022, they predicted this unexplained shift from a US inventory draw to a sudden build with no explanation, no reasoning as to why this happens. And we look at the April update, it's been completely wrong already. The March has been totally false. And they predicted the same thing in April, with nothing to back it up. So this data is all garbage that's coming out of the EIA in terms of predictions on the future inventories, on future demand, future supply. It's totally wrong. And I don't think we should be taking it as any sort of proxy. The real data, I think, will continue to show draws. And thanks to Peter for putting these together. Peter, his Twitter handle is here for anyone that wants to follow along these. So yeah, the headlines, there was a headline a month ago about US production is at record highs. There was a headline 2 months ago of the same thing. They're both wrong. So I wouldn't rely too much on what the news is telling us. The data makes the trend as clear as it can be, really be. Is there any questions on the inventory side before I move into demand and more of the demand side of the equation? I see there's some conversations going on in the chat here, so I'll just let the listeners continue with that, because I don't have anything to add. There's a question on Canadian production. How much can Canadian production really increase? Not really much, really not much. The reason I talked about my favorite names and why they could potentially beat on production, think about a Whitecap. If they beat production by 5% and you take their gas and oil ratios into account, that's like 4,000 barrels a day. It's nothing. You look at a Meg Energy, if they beat production by 5%, that's 5,000 barrels a day. It's nothing in the grand scheme of things. So you add all these up over the entire Canadian market, you get to maybe 100,000, 200,000 barrels this year. On a global scale, it doesn't move the needle really at all. So that would be my answer to that. Yeah, I did talk about Saudi storage here earlier, Shale. So please check that out. How confident on the China inventories are you? I like the Morgan Stanley data. I think that's pretty good data. I believe it's from Kepler or Keros. They have really good data. And then Vortex actually has a new Chinese inventory that they've been sending to me, which has been agreeing with. It's not exactly what we see here from Morgan Stanley, but it's pretty close. So, if I have 3 or 4 sources that generally are agreeing, that's how I'm more confident in the Chinese data, because to your point, that's very hard data to really get. So the White Tundra portfolio is not updated right now. It's still April 4th, I believe. I will be updating that here next week, probably early May. So yeah, thanks for mentioning that. Okay, so let's move on to the demand side. What's going on in terms of world demand? Let's look at America first. So we had this huge spike earlier in the year, and then we're seeing a drawdown here. This doesn't include the latest week, which was at 19.8, I believe. So somewhere rebounded anyway. It's beat the trend. So what's going on here? I think a lot of people can think here that what's happened is that this data is completely wrong, and so is this data. They have overestimated demand for the first 3 months of the year, using the other oils section, which if you go back and read the EIA reports, the other oils draw was absolutely massive, and the demand was just off the charts for January and February. And now the data has to be kind of smoothed out and fixed. So we take this entire thing, and it's kind of like a smooth line here. And I talked about trend reversals in crude inventories worldwide. There's been a trend reversal in US product demand as well, big time. It went up 4% last week from the week before. So the data is hazy. It's not accurate really week to week, even month to month. But the fact that there's been a trend reversal to that extent, from dropping 3% every week to going up 4%, again, gives me an indication that something has changed in the American supply demand, in the worldwide supply demand. Something has changed. We have come to this inflection point in the last 7 to 10 days, call it, setting us up for the next leg up here in world oil demand, and inventories drawing, which obviously correlates to the price of oil, which is why this last week I had a bunch of margin room that I had a bunch of cash, some cash sitting around, and I basically have deployed everything last week. So, I feel pretty confident that we've had an inflection point here, based on the inventories and the demand data we're seeing. I expect American demand to continue going higher here into the rest of the summer, as gasoline picks up, diesel picks up, the road maintenance season, road building season, jet fuel, all the way down the line. Weekly US gasoline demand, I don't have a latest update here, but we've basically been at this bar for the last 2 months, call it, give or take 1% or 2%. So, well above where we were last year this time. And you see here, as we go into May and June, into the summer, demand usually picks up. So we expect this number to continue going up, especially into May and June here. We see the US total vehicle miles driven. Take your 5-year average. February is your lowest, then you have March, and then it basically goes up. It goes up throughout the summer by about, call it 7-8% in terms of total vehicle miles driven. This year could be even higher. We have all this pent up demand. We have all this weddings that people haven't gone to. They haven't gone camping in 2 years, 3 years. They haven't gone to Yellowstone. They haven't gone to wherever else, do hikes and whatnot. So I expect this to continue higher, potentially even higher than the growth in the previous years. Okay. The next one we have is daily diesel demand. So diesel demand is running strong. We have pretty much every part of the world other than Russia, I believe this is at the bottom. Diesel demand is very strong. Europe has kind of come down a bit. North America is right where it should be. Asia is going higher. So what does that mean? At $100 plus oil environment, diesel demand hasn't really dropped because they need it for trucking, they need it for farming, they need it for the some of the jet fuels, I guess, can be lumped in here. Nothing's really changed on the demand spectrum. We had the Omicron took a much bigger hit to the daily diesel demand than the price of oil is doing. What we got here? Yeah, that's pretty interesting. So there's a comment here that every hotel in Yellowstone is sold out, and the VRBOs are more than $1,000 a night. These sorts of data points do end up mattering as to predicting what's going to happen this summer. But yeah, diesel hasn't really moved. A small dip in Europe, but I believe that's going to come back here. And look at where Asia was pre-Omicron. There's about another 300,000-400,000 barrels a day left just to get to that, let alone the summer driving season and the planting season and everything else. So I stress this point again. We are at $100 oil and sustaining that when there's a lot of demand yet to come on the market. It's pretty interesting to think of it that way. Let's look at jet fuel. The flights were pretty high in April, then they had the Chinese drop off, and now we're back to our summer gain, if you will. We're slowly building, not quite at 2019 levels yet, but getting close. And why do I mention that? Because this gap that's left here is all long haul intercontinental flights. So every flight we're adding today is not just a domestic flight. It's going to be a long haul flight going from Paris to New York and London to Bali and Bali to Melbourne, et cetera, et cetera. So as this continues to take up, every incremental flight is adding your long haul jet fuel demand. So although our flights are close to 2019 levels, our actual jet fuel demand is not even close to there yet. So just something again to keep in mind that nobody will really explain. They just keep saying flights are 20% below this and 30% below that, but the jet fuel incremental demand increase is going to be much higher with these longer flights. And here's the jet fuel consumption prediction here. So right now we're at roughly 5 million barrels a day of jet fuel. By July, we're going to be at 6.3. So in the next 3 months, we're going to add roughly 500,000 barrels a day of jet fuel consumption every month. And the market is already at $100 a barrel with record low jet fuel inventories. So just my opinion again, my 2 cents here. Anyone who can look at this and tell me that oil prices are going to fall to $60 or whatever they keep saying, none of the data agrees with that, is how I'll put it. None of the data supports any sort of conclusion that oil is going to fall because of demand destruction, it's going to collapse. None of the data agrees with it. So it makes me feel very confident in my oil equities and kind of holding them through the summer, and as we see this increased demand here. So Chinese flight demand. So we see what happened. They were at 11,000 flights a day. They went all the way down to 2,000. So there was 9,000 flights that came offline in the last 2 months, call it, that are now going to come back online in the next 2 months. We see the trend has reversed, and it's staying that there. We had a false reversal here, which got me a little too bullish on Chinese lockdowns in early April. But this seems to be more of a sustained increase again, back to where we should be going. I look at this data point every day. If there's any hesitation in this data point where it starts going back down, one should then again look at Chinese lockdowns and kind of what's going on. But until that happens, I'm confident the lockdowns are mostly behind us, and the overall country is starting to come back into its form. We know that even with lockdowns, Omicron was impossible to control. It's been there for just about 3 months now, roughly, which is the rough time in every other country. So it could just be fizzling out on its own. Again, it's been there 3 months. The other countries show that that's kind of the rough cycle, even with the lockdown. So very important data point. When China ramps up, they ramp up fast. Look at these rebounds here in jet fuel. It happens fast. Again, a lot of the Chinese flights are domestic flights. When these international long-haul flights come online that go to China for business, for travel, for meeting friends and family, the incremental jet fuel that's going to get added is way more than what's currently being used. So I keep stressing that point because it's not just the number of flights that we need to look at. It's how much jet fuel does that incremental marginal flight use. That's more important to think about. India, already at 2019 levels. I would bet this continues higher and beats 2019 by a pretty long shot. There's been a lot of weddings in India that have been delayed for the last couple of years. A lot of business travel that is going to come back. So keep an eye out for this to beat 2019 by, I would say, 10% or more this summer. India is building a lot of airports. People are getting more used to flying, even if it's just within India. If it's to Dubai, it's to Malaysia, whatever. So we can't just compare things to 2019 levels in terms of jet fuel. My opinion is that we beat the 2019 level by 10, 15, 20%, up to 30, 40% in some countries, which I'll show you here. Some countries are already on a path to that. Australia, Canada, pretty close to 2019 levels. Same theory with the pent-up demand. Japan, Malaysia, I talked about a big inflection point in the last 7 to 10 days. It's pretty clearly visible here, where Japan, Malaysia, a big summer tourism center. Look at the slope of how that's changed in the number of active flights. It's not a gradual increase. It's going to go straight up as people travel, as the restrictions are down. Nobody will tell you this. None of the news articles are talking about this random, well, it's not random, but this sudden huge increase in jet fuel usage. It's going to be sudden. We see the trends already forming. We look at, what's this up here? South Africa, we look at Indonesia. Indonesia, another big summer travel center. We see the big change in the slope. South Africa, the reason I bring up South Africa is, can anyone tell me on this graph where Omicron happened in South Africa? This is the 2021 line in dark blue. There is no indication of it. So this is a minimum level of flights required to keep the country running. and they just didn't care, and nothing really happened. This graph always gets me laughing, because people say Omicron was discovered in South Africa and they banned the flights and all this, and nothing, you can't even find it on this graph. So again, Indonesia going up. Vietnam recently had the Omicron here, rebounding pretty fast. Spain already above 2019 levels, dropping a bit, which is interesting, but it's dropping from a position above 2019 levels already. Germany getting there, the UK slowly getting there. Europe might be one where you might see a little bit lower jet fuel demand still, but that's a bullish catalyst. That's a catalyst for the upside. If travel demand is higher this year to Europe, we might see even more jet fuel consumption and local consumption. So people often forget that a lot of European countries, their GDP is tied to travel. Germany is probably around 10%. The UK is probably around 10%. Back here. I know for a fact that Greece is 20%, Croatia is 25%. So, countries like Indonesia and Vietnam, as this travel and tourism comes back, that means people are driving motorcycles, people are taking Ubers in these countries, people are driving around doing road trips. So it's all excess demand that's not properly being forecasted. From my point of view, Mexico, the flights in Mexico are already 20% above 2019 levels, and they're staying that way. We see no decline yet. Look at the Dominican. We are at 25-30% above 2019 levels. People are traveling, despite what the people who are sitting at home and watching CNN will tell you. People are traveling a lot. So these sorts of trends, are they going to be same for every travel destination once they open up? One to watch for. 30% above 2019 levels is not a small number. That's pretty big. Colombia, again, 30% above 2019 levels. Greece, I mentioned 20% of Greece GDP is travel and tourism, running above 2019 levels. They've been running that way since before April, and no sign of stopping. So the summer jet fuel demand is going to be a big number. If that beats estimates by 500,000 to 1 million barrels a day, which is not in any prediction that I've seen out there, where does that take the world supply demand? Where does that take oil pricing going forward? These trends that you're seeing, oil has been above $100 a barrel since March, early March. Has any of the trends changed? No, not really. I don't see any impact of higher oil pricing, at least so far. Yeah, great point. A lot of South Asian and Filipino service workers around the globe haven't been home for 2 years. Great point. Airspace restrictions are making quite a few long-haul flights 10 to 30% longer. Another great point. Does jet fuel mean less gasoline demand? To some extent, but not really, because jet fuel almost does its own thing, not linked to gasoline demand. They are in a way, but not to the point that excess jet fuel demand is going to crush gasoline demand. It doesn't really work that way. They're not that synced. These are old headlines, but it kind of goes to show you what's happening in Asia. Singapore simplifying their rules, Bali opening to tourists, Thailand has quarantine-free entry now, Philippines dropped their 2-year ban. These countries rely on tourism. They are going to be gung-ho after 2 years of no tourism income to bring them back to re-energize the local GDP and businesses big time. big, like it's big time. It's not just, yeah, we'll open up this summer and we'll kind of see what happens. They're opening up. They want to have the business come in. They want to have tourism and travel happening, and they're going to do whatever it takes. So keep Southeast Asian oil demand in mind here and kind of what's happening here. Okay, let's talk about India more specifically. Demand keeps going up. If we take these like 3 months out of the equation, you can't even tell that there was a COVID here. It just kept rising. LPG, liquefied petroleum gases, and gasoline continues going up. It just continues going up. There's nothing stopping it. Indian refinery crude runs. So how much crude does a refinery process? Record high. February was a record high. These refineries are running at 100% plus usage, utilization. So they're pumping in way more oil than even they're designed to take. Why? Because the demand is there for the products. It's as simple as that. So where is the demand coming from? Well, highway construction. From 2009 to 2014, India built 5,000 kilometers a day or 5,000 kilometers a year of highway. The last 7 years has been 9,000. The last year of full data we have, their goal was 11,000. They built over 13,000 kilometers of highway. Countries don't build highways for them to just sit around and do nothing and look pretty. They build them because the demand is there and people are going to use them. So think about 13,000 kilometers of highway added in India, what that's going to do for the motorcycles, the two-wheelers, the passenger cars, diesel, etc. It's going up big time. Utility vehicle sales, look at the year-over-year growth in some of these numbers, 50%, 30%, and then 20%. Those are big numbers for utility vehicle sales, year-over-year growth. So there's a couple questions here. Do you know if India is adding refining capacity? Yeah, so India will be adding 5 million barrels a day of refining capacity by 2030. What does that tell us about where they think their own internal demand is going to be by 2030? People love to ignore facts. That's a fact. India is going to be refining more oil because they think their domestic market needs it. And they might export a bunch of it, but a lot of it is for domestic use. How does the extreme heat India is experiencing? Oh, very good point. I actually have a data point that proves this, exactly what you mentioned here. What's selling in India? People in India no longer want passenger cars. Like, people say India is poor and people don't have money to buy vehicles and all this. They're shunning passenger vehicles to get into SUVs, sports. They call it utility vehicles, but I'm sure they mean SUVs and trucks and big other vehicles is what they're trying to say here. From 2021 to 2022, sales of passenger cars are dropping 7% or so, roughly, but sales of SUVs have gone up like 40%. So India is not poor. The people who have the money to spend on gasoline and diesel and vehicles are price insensitive for the most part. Yeah, there's a lot of low, how should I say this, lower middle class, I guess, who are sensitive, and there's a lot of people that can't even afford a house or a motorcycle or a bicycle. But the people who are buying petroleum products are mainly insensitive. They don't really care. They're willing to pay what it takes for them to enjoy what the American has, the camping and the road trips and all that. And they're buying more SUVs by a big margin. India's LPG consumption. This is also off Twitter, so thanks to, I forget the name of the person who makes these, but really great data on Indian demand. It's going up 8% every year. The latest data had it at 600. So it went up almost 10% from 2020 to 2021 in a COVID year. Yeah, demand is going up big time. India's demand in March 2022 was the highest it's ever been in a month that oil averaged 100 plus, 105, maybe 110. Diesel is up, petrol, which is gasoline, is up, LPG is up, jet fuel, fuel oil, bitumen used to build roads, that's still going up. Everything in India, the demand is going up big time, much higher than the 4 or 5% or 3% that the BP outlook or whatever will tell you. It's going up a lot more. And anyone ignoring the difference in demand increase and just using lazy calculations and just using some sort of a trend continuation from 2014 or 2010 onwards, is going to be underestimating demand a lot, big time. You know, I would almost argue that a lot of these so-called analysts don't even know how to predict emerging markets oil demand. They don't have the right sources or the right predictive modeling to accurately even predict it. So they just use 1 or 2% or the whatever number from the last 10 years, might end up looking quite wrong as we go onwards here. As I mentioned, Indian overall demand, highest it's ever been. Sorry, that was in February. So oil prices were a bit lower, but doesn't change the fact. And then March, they were even higher, the highest they've ever been. Indian driving demand, this is 2022. I don't know what the scale is exactly, but it looks like it's 20% above what it was from the pre-COVID benchmark right here. 20% demand increase in 2 years for driving. That's big. That's a big number. Number of airports in India, they built roughly 50 airports in 20 years from 2000 to 2020. So 2.5 airports a year. In the next 10 years, they're building roughly 15 airports a year. Again, this sort of predictive modeling, I don't think is being used by the analysts. They're using the same linear growth and just pumping them into the equations. But when you go from building 2.5 airports a year to building 15 a year, what's that going to do for your jet fuel demand and your road trips demand and your traveling demand? You know, it's not 1%. It's going to be not 5%. It's going to be much bigger than that. And looking at the actual data kind of gives you a better idea of what's going to happen and why I believe a lot of the data out there for world oil demand is totally wrong. You know, Mike Rothman at Cornerstone has been a big proponent of this for a long time. And I believe his insight is going to be even more prevalent now that the emerging markets are actually in this exponential demand phase. There's a comment here about the Indian EV market. So the market for electric vehicles in India is not very strong. They do have electric vehicles over there, but they're not very well received. The top selling EV passenger vehicle costs 2 times the gasoline version. It's not quite price competitive, and there's lots of other issues in that electric vehicles, as we know, need the charging infrastructure before they get really mass marketed, and India doesn't really have that so far. Internet percentage, how many people have access to internet in India? You know, we see this linear growth and then it's gone into this exponential growth here. The more people have access to the internet, they see TVs, they see barbecues, they see people road tripping, travel blogs, they get advertisements for going to Dubai and traveling and buying fancy motorcycles. So you know, again, something that's being very ignored. Once, more than 50% of the people now have internet. That means they're talking to each other, and they're converting other people into the Western world and what the Western world has. Everyone has their own opinion on what all of this means. My opinion is that Indian oil demand is going to surprise so far to the upside. It's going to make people look very stupid who were using linear projections from the 2000s or even the 2010s. Yeah, it's going to be very, very interesting going forward. Electricity in India. Look at the last 10 years. We almost saw only electricity in the hubs for the most part. Now we have electricity basically everywhere. We have, people have a higher quality of life. People have access to electricity. They have access to reliable sources of power. They're no longer worried so much about their day-to-day survival. They can focus on discretionary income, getting better jobs, better education. It all goes in a circle. The modernization is all a trend that, in my opinion, again, is being ignored. This is going to be a very interesting country going forward, with 1.3, 1.5 billion people wanting what America has. Indian peak electricity demand higher than it's ever been. Where is the demand destruction? You can't point that out on this graph because there isn't any, despite what people keep saying about LNG pricing and gas pricing and whatnot. Air conditioning in India. Only 8% of the people in India have air conditioning. In a country that's going through heat waves and will continue to go through heat waves for a long time. That's just where the country is. What do ACs use? Air conditioners, they use, they're powered by electricity. And electricity fueled by energy, whether that's coal, whether that's natural gas, whether that's fuel oils, solar, wind, it doesn't matter. The point is 8% of people in India have air conditioners. Singapore is 77, Malaysia is 80, Vietnam is 49. Can we not expect India to get to where Vietnam is in the next 10 years, 49%? Add in 40% of the Indian market getting air conditioners. That's not a linear growth by any means. Let's switch to China, the other big consumer in the world. So before I go here, is there any questions on the Indian demand? No. Okay. So we'll move to China. We'll get the demand portion done. Then we'll take probably a 10-minute break, 10-15-minute break, and then we'll come back to the supply portion, because I think the supply portion is getting even more important. And there's a lot of slides. So yeah. So Chinese crude imports relatively stable. They've gone down a bit. Alarming headlines being thrown at us that Chinese oil demand is cratering, it's collapsed, blah blah blah. Nothing really has changed. The imports have gone down a bit. Their inventories haven't really built, and demand is still there. If the imports were lower and the demand was lower, inventories would have built big time. But we don't see that. So do we have exact Chinese demand numbers? No. But using supply and using inventory, we can predict what the demand was, and I don't see any big issues in demand really. It's down to the same level as March 2020. Yeah, the Chinese imports are down to the levels of March 2020. All throughout this time is the time they were draining their excess inventories and their floating storage. Right here, you could say, is when the demand destruction is happening because of the COVID lockdowns, March and April. But my point is that if the demand had actually been impacted big time, the inventory should have built, but they haven't. So the demand is still there. As they come out of the lockdown, we will add back to demand. And because they haven't built inventories, they will have to be forced to import on the open market yet again. So another bullish catalyst. Growing demographics in India. So I did have a good chart on the demographics of India, how people have gone from the lowest class to the lower class and to the middle class, but I lost the screenshot somewhere, so I will add that into the next one. But thanks for that. Chinese tanks, we see that in the COVID time, they basically filled every tank to the brim. This is, I want to say 3 months ago. We can see some of the tanks are emptying. They're floating roof tanks. So as the oil comes down, the roof itself falls down, and we see, these tanks are getting emptier. This is basically all low. Some of the tanks here have started to drain compared to where we were. This entire area is down. Yeah. Chinese inventory is not the most transparent, but we can do our best job of understanding where we are based on what's going on and satellite data. Chinese electricity consumption, even COVID couldn't stop it on its way up. Energy consumption in terawatt hours, it still continues to go up. Look at where India is, and look at where Africa is. You see how China went from this linear trend pre-2000 to this exponential trend. I would warrant to guess that that's what's happening in India right now. They've been on this linear trend for a while. They're going to be into this rapid expansion phase over the next 10 years. They're going to add much more to oil demand than the predictions currently are showing. Electricity demand worldwide growing by 7,000 terawatt hours in the next 10 years. Renewables are a big source of this, but look at coal and oils. It doesn't really drop, despite the big increase in renewables and nuclear and whatnot. The reality is that global electricity demand is growing by about the same amount that renewables can provide. So the initial usage currently doesn't just randomly fall off to zero. It's still going to be there, and which is kind of one of the biggest points here is a lot of people think that just because renewables are out there, oil is going to collapse to zero usage. Not exactly how it works at all. Yeah, I'll talk about the S curve here. Just give me a sec. Thank you for the question. Workplace patronage. How many people are going to work, specifically to work? It's back to pre-COVID levels. So all this talk about work from home being the new normal, for a lot of people it is, yes. But on the overall worldwide global GDP weighted, we're basically back to pre-COVID levels of people physically going to some place to work. You'll find that a lot of people who work from home actually end up going to coffee shops and work, or they go, to the schools to pick up the kids and whatnot. So the actual global gasoline usage hasn't really dropped because they're not just sitting at home all day. They're actually going out and meeting people and whatnot. Something to keep in mind. Work from home doesn't mean sit at home all day and do nothing either. Retail and recreation. Pre-Omicron, we were at about 107%, 108% of pre-COVID levels for retail and recreation. Where are we headed? Again, the last 7 to 10 days, we've seen this inflection point. All of a sudden, we go back here, we've seen this inflection point. Same thing here. Going on our way back up. to where are we going? Are we going to get to 120% of pre-COVID levels? We could. Why not? Pre-Omicron, a lot of places were still shut down and we got to 107, 108%. So comparing everything to pre-COVID demand is not the right way to look at it. We have to look at it, what's the demand today and how much demand can we expect to add over the next 6 months, over the next couple of years. That's the way to really look at it. Current traffic congestion, there's almost no cities that are down 20% or more in terms of traffic congestion. Most of them are up 1% or more, roughly 80% of the countries in this sample. Oil consumption growth, never mind the emerging markets, it's still going up in America, China, India, Thailand, Vietnam, Philippines, Bangladesh. It's all going up. There's no place in the world where oil demand is actually starting to go down. Maybe Japan, you can make a case for it, but there's other factors for that besides just strictly what the people want. Demand going up. Where's the demand coming from? They have India at roughly 250,000 barrels for 2022, which would be 5% year over year. And what if it's 8%? What if it's 10% year over year? That's an extra 250,000 barrels a day, which is not being factored in. Southeast Asia, same thing. South Korea, other Asia, China. This one could be a little bit lower, possibly because of the early losses so far this year. But on the overall, there's no data that shows that oil demand is going down by any means, or the death of oil or $12 oil, as famously preached on TV. Chinese crude oil imports. There was a talk here that we're back to March 2020 levels. We're back to record high levels is basically what you're telling me. It's not like we've dropped into some sort of weird void or something. It's grown substantially, and it's going to continue to grow substantially back to its, even if it doesn't continue on this trend, this exponential trend, it's going to at least go to some sort of linear growth as we go here into the future. I've talked about these before, but basically, China's total oil consumption in the year 2000, when they switched from a linear growth to an exponential growth, was roughly 5 million barrels a day. That's exactly where India is today. China's population back then was, I'm not exactly sure what it was, but the population in India today is roughly the same as it was back then. So are we hitting an inflection point here? I believe so. And I think, this green line goes from this slope to going into more of this China history slope. And again, I keep saying the same thing, but it's very important for future demand going forward is going to be a massive factor in where oil prices end up here over the next decade, over the next 6 months, and as an investor in oil. Energy use per person in Africa, one refrigerator in America uses 459 kilowatt hours a year. This is 500 million people here represented by these 6 bars who use less energy per year than that, than one refrigerator. They use less energy than that per year. Some of these countries use way less. Nigeria is a growing population. Ethiopia, I believe, is the second fastest growth rate in terms of population per year. So how far up can they go in the next decade? A lot. Totally being ignored, not even being talked about. No one talks about Nigerian internal oil consumption or Ethiopian internal oil consumption. Something to keep in mind. Oil demand is not going anywhere. It might even accelerate as we go into the future here. This is put out by BP. It's a global energy outlook as to the Human Development Index, which tells you the quality of life of people versus the energy consumption. We see where America is. As your quality of life gets better and better, you end up using way more energy per capita. Why? Because instead of one barbecue, you got 4 barbecues, and you got a vacation home in Phoenix, and you have a ATV and 3 motorcycles, you know, et cetera, et cetera. So the per capita usage is way higher. 5.5 billion people are in this box here, which means they're in this linear phase of the S curve. They will start to incrementally use way more demand per person. When you go from riding a bicycle to riding a motorcycle, your energy usage just went up infinity% in terms of petroleum demand. So keep that in mind. Out of this 5.5 billion people, 4.5 billion are in this box. They're on the cusp of this linear to exponential transition. Also, they are being affected by having access to the internet, having access to electricity, having access to running water. Once the basic survival needs are out and they move further in the Human Development Index, they focus more on living a better quality of life, and they start spending more discretionary income. They want more convenience. I know I keep hammering the same point across, but basically the entire world, the entire world is on this cusp. So using any predictions from 2010 or 2000 is going to be completely wrong. From 2000 to 2015, it was only China that was expanding at this massive rate. Now, India, Bangladesh, Nigeria, Vietnam, Sri Lanka, some of the other countries in South America, they're all in this little box here and set up to have this massive expansion moving forward. Energy and population outlook. Population is getting bigger. The energy consumption per person is getting bigger. It doesn't get any simpler than that. I like to bring this graph up. This is America in the last 70 years. The population has gone up 2x. Number of households has gone up 3x. Drivers 3.5x. Number of vehicles in operation 6x, and the total vehicle miles has gone up 7 times. This entire 70 years in America is going to happen within 20 years in India, in emerging markets. And why is that? Because in the 1950s, we didn't really have access to vehicles that much. So it was a very slow uptake. Now the uptake of vehicles in a society is much, much faster. So if you take the total vehicle miles traveled in the country and you multiply it by 7 in a 20-year period, that's a lot more than a 3% growth rate or a 5% growth rate in your petroleum demand. So we'll see how it plays out moving forward. World demand growth. This was done by somebody on Twitter. Amazing work done, because people kept saying, well, the oil prices have gotten so high and the dollar is so strong that these markets just can't afford energy anymore. So what they've done, this person, I forgot their username, but they have a per capita oil and a per capita income in the local currency. Then they've put an oil price on it and an exchange rate to tell you what is oil costing in terms of the share of the income of the average population. We look at 2019, you stick a $90 oil on it with the current exchange rates, and you look at countries like India, it was at 6%, it's still at 6%. You look at Bangladesh, it was at 2.7%, it's now at 1.9%. So the localized incomes of these countries, even after the exchange rate, have grown much more than the price of oil or the loss in exchange rates that these countries these countries are affected by. So it doesn't really matter. Like when you look at it in 2011 terms, maybe the price of oil today is like $500 a barrel in Indian rupee terms, but in terms of the cost as a percentage to their average income, it's the exact same. So, which is why the demand destruction, I think, argument doesn't hold any weight. People seem to think that demand destruction is just going to destroy these emerging markets. That's not really what's going to happen. You know, the data is proving otherwise. If anyone has data that supports the idea that $120 oil is going to totally collapse the economy of any of these countries, I'm very willing to have a look at this. And in fact, I would appreciate if you can email that to me, because it's a big factor going forward. SUV sales, 2010, price of oil was high. 2012, it was high. The number of SUV sales and the global share just keeps going up. Even during COVID, when people were struggling and didn't have money, etc., it still kept going up. People want SUVs. People want convenience. They want safety. They want to do road trips and skiing trips and camping trips. And once there's so many SUVs and trucks out there, people just don't feel safe driving little vehicles anymore. So then they start buying SUVs and trucks and V8 engines. So what do SUVs do? They consume more gasoline and more diesel. People say they want to be green, but then they go out and they buy a big GMC Yukon 9-seater with a V8 engine on it. Doesn't really add up to walking the walk. Same thing in Canada. Until 2010, it was relatively even, and then trucks, vans, and SUVs just went crazy. Passenger cars started dropping. Yeah. RVs, travel trailers, camping trailers, truck bed trailers. 2021 was the highest year ever. It beat 2017, I believe it was, by 19%. 2022 is off to an even stronger start. So people are buying RVs, which means they're buying trucks, which means they're buying side-by-sides and ATVs and snowmobiles and every other thing. And they're going to be camping this summer. They're going to be using up a lot of petroleum. So now, when I posted this, people told me, well, you're going to see these units on the used market in 3 years and all this. And people have been saying that forever. People have been saying the same thing about the housing market collapse and the vehicle market collapse, etc., forever. It hasn't come yet, and I don't think it's going to come this time either. There's too much stimulus out there. People have a lot of money with the consumer balance sheets. The people who buy RVs, I don't think are being in any sort of money issue right now, but I'll talk about that here later as I go. Global coal demand. They said coal is dead 20 years ago, and coal consumption is the highest it's ever been. In fact, it's going to continue to be the highest it's ever been for the next 4 years. So anyone telling you oil is dead, they weren't even able to kill coal, which is way dirtier than oil. It has way more emissions than oil. Is going to be at its highest usage ever for the next 3 years running. So oil is not dead by any means. People are unwilling to look at the data. They want a virtue signal and pander to politics. The data does not agree with any of it, which is it's just amazing how many people keep saying the same thing, that oil is dead. We're never going to use oil in 5 years and this and that. And they don't even realize that coal is at its highest usage ever. Just amazing. A few more slides on the demand and then we'll take a break here. Norway demand. Norway was the big EV adopter. 2021, 65% of the sales were electric and 92% were electric or hybrid. Gasoline demand hasn't really dropped. 2020 is not the right number to use because of the COVID issue, but oil demand hasn't gone to zero by any means, despite the high sales of EV vehicles, electric vehicles. This is Norway's gasoline. What is this graph here? Yeah, I believe this is Norway's gasoline demand. Gone down as the EVs come online, but the overall oil consumption is pretty stable because people maybe are not using as much gasoline, but they start using diesel. You know, diesel is big in Europe, and the overall country's consumption is just gone up as they modernize, as they kind of build out. Again, electric vehicles are not going to move the needle. Just because you're selling 80% of your vehicles are electric, it doesn't mean that the oil demand is going to go to zero. In fact, not by any means. It hasn't even gone down noticeably. And we look at the cumulative electric vehicle sales. That's roughly 10% of the global electric fleet is in Norway, and nothing has happened. These 4 countries, car sales by year. So let's look at Norway. Car sales are still going up. Vietnam going up big time, the number of car sales. Morocco going up. Hungary, which most people think of as a developed European country, has tripled their car sales in the last 10 years. You know, if you ask someone, how much do you think Hungarian car sales have gone in the last 10 years? I don't think they would say 3x, because nobody's paying attention to the data. They just keep pandering what the media tells you, what people say about energy efficiency and all this, without actually doing anything to solve the issue. Peru's oil consumption continues to go up at about a 4% rate. It didn't stop in the high price years. It didn't stop in the low price years. It continues to go up. Oil production continues to go down. So Peru, which was importing X amount of oil, is going to start importing more and more. Oil exporters like Mexico, which were previously exporting oil, are going to stop exporting oil due to their internal consumption. So what's the world setting up for? Are we setting up for something where people have totally ignored emerging market demand and been completely wrong on it, to the point that we suddenly fall into this supply crisis? Are we already in that supply crisis potentially? You know, some things to think about. This is not just the same market as it was 10 years ago. It's not the same market as it was 20 years ago. We have to think about things as they are. History repeats, history rhymes, they say. Yes, it does. But we also need to look at things as they are as well, without trying to compare everything to, is this 2008? Is this 1980 this? Is this 1940 that? Things change a lot. European product demand, we see European driving has also gone up more than the normalized zero here, considerably. It's going higher and higher. European refining margins are another way to tell what demand is. The stronger the refining margin, the more the product demand is. And I don't see any loss in this so far with the higher oil pricing. So just keep that in mind. Subsidies, no demand destruction. Alberta stopped their provincial gas tax. Global fuel subsidies are ramped up. Some of these taxes and carbon taxes are going to be under extreme pressure right now, because it's an easy lever to pull to reduce the cost to the average consumer, who is getting more and more angry at the rising cost of inflation, fuel, energy, real estate, everything else. So watch for these subsidies and taxes to soft cushion the impact of the higher prices, cause way less demand destruction than people are projecting. California, rebate to taxpayers. Natural gas demand, I'll just throw this in there because it's becoming more and more of an issue. Alberta natural gas demand is way higher than any previous year. US domestic demand is pretty strong as well. Western Canadian natural gas storage. This is what our favorite Canadian oil and gas equities trade at, the AECO pricing. They're having an extremely hard time refilling storage. The storage should be going up, but instead it's going down. We're drawing more on storage. America, below the 5-year storage, heading there, but not quite. Again, Canadian gas storage is so low. It's pretty hilarious how low it's gotten from just looking at a graph standpoint. US storage, very low. European natural gas production, people don't talk about this. They keep saying the natural gas storage is fine in Europe. It's fine. It'll fix itself. They don't tell you that natural gas production in the EU is down 60% in 10 years. So you can't just compare this to a 2014 or a 2011 when they had their own native production to refill their storage and feed the energy consumption in Europe. They don't have it anymore. It's down 60% in 10 years. Ignored. You will never see this mentioned in any sort of thing about refilling storage and whatnot. They just say, oh yeah, once the Russia crisis is resolved, Russia-Ukraine conflict is resolved, we can go back to refilling storage. It's like a sleepwalking. When the Saudi minister said that they're sleepwalking into the energy crisis, this is what he's talking about. No one is paying attention. The people who make the decisions, the politicians, the policymakers, not paying attention. They're in their own la-la land of green everything. LNG supply outlook. We just saw Shell or Exxon, was it, or Shell pull out of the Sauk Lane LNG project. So take this Russian construction out, the Russian LNG construction out. We're heading into big natural gas short supply here, undersupply, even right now. So again, anyone telling you that it's all fine, it's all going to resolve itself, European gas is going to normalize, things are going to be fine, I don't think is understanding the scale of the problem here, the scale of the undersupply that we're in. Asia LNG demand keeps going up and supply is just not there. LNG from the US has been rerouted a lot to Europe to help with their issue. But what does that mean? That means it hasn't gone to Asia. It hasn't gone to India and Pakistan and Sri Lanka and Japan. So you can't just reroute everything to Europe and say, oh yeah, things are fine, we'll just continue this way forever. Because the other countries that this LNG was going to are now forced to find other ways to meet their energy needs. Pakistan was burning fuel oil. So anyone who's against natural gas development has basically told Pakistan, yeah, you guys like continue burning fuel oil instead of natural gas, and that's fine because it makes us in Europe look better. It doesn't make any sense what's going on here. And it's just mind-boggling how people are so ignorant to what's happening here. But anyway, okay, so that's it on the demand side. The supply portion is very long. It's gone longer and longer. It's probably going to be 100 slides if I'm not wrong. So let's take a break here. Maybe 10 minutes. We'll reconvene at 2:05, let's say, Mountain Time, and then continue with the supply side. In the meantime, if there's any questions on the demand or the inventories, please feel free to put them in the chat. If not, we'll get started here on the supply side, where I'll talk about Russian oil, I'll talk about Libyan oil, shale, basically every source of supply, Iranian oil, Venezuelan oil, and we'll talk more about the supply side of the program. But yeah, we'll take a break here and we'll reconvene at 2:05. there will be a replay, yes, posted afterwards as well. Thank you. We'll get started on the supply side, and then I will leave the Twitter open so we can continue the conversation. I know there's always lots of comments after the fact. Maybe we'll have another 15-hour session here today on the Twitter and continue it from there. But yeah, for anyone on Zoom, we'll get started. Anyone on the Twitter that wants to join for the visuals, I should have said this earlier, but if you go to the whitetundra.ca website, go scroll to the bottom under events, the Zoom link is there, so you can actually look at the visuals that I'm talking about as I go. And the recording also will be on the website by later today, probably a couple hours after it ends, for anyone that wants to watch that. But yeah, so we've talked about the inventories. We know what's going on there. The demand side looks exceptionally strong. You know, as was discussed here, in the emerging markets looks exceptionally strong and maybe is being ignored. But the demand within the North American and European market is strong to begin with. It hasn't dropped off by any means, and probably is going even higher. So yes, I did try making the Zoom link clickable on the website, but what happened is it went to the same color for some reason as the background. So it became a clickable link, but you couldn't even see it. So I am still working on this. Squarespace has some weird things going on where you can only adjust so many colors. But that is something that's been bothering me too. So I will fix that, G Money. Okay, so supply, the elephant in the room, Russia, what's happening? You see all this information that Russian crude export hasn't dropped and nothing's happening, and they're actually exporting a bunch of crude. Fair point. That's exactly what's happening. The Russian oil export has basically not dropped. This is pre-February. It did drop, but then we've had this massive week here. So when you average out the last 4 weeks, we're actually hasn't really moved that much. And that's what they keep pumping out in the headlines, that Russian oil is still out there and Russian oil is still being sold, blah, blah, blah. Let's look at Russian products. Russian residues, which is your fuel oils and your asphalts and whatnot, are down 300,000 barrels a day. The Russian residue exports, okay? Let's look at diesel. Diesel is down roughly 300,000 barrels a day. Naphtha and gasoline, the exports are down roughly 200,000 barrels a day. So yeah, the crude exports are the same, but the product exports are down 1 million barrels a day already and show no sign of recovery. How come we don't see headlines saying that, oh, look at this, Russian products are down 1 million barrel a day and show no sign of recovery? I haven't seen a single headline that said that. They all seem to keep pumping the same negative news that crude exports haven't fallen. Crude exports haven't fallen. Europe is still buying crude. India is still buying crude. America is still buying crude, you know, blah, blah, blah. The real data is showing a 1 million barrel a day sustained loss of total petroleum export already. Now, what if the Russian crude exports now in May and June drop by another 2 million barrels a day? The total hit from the Russian issue here is going to be way more than what the people who are just looking at crude are going to understand. Because when we look at oil supply demand, you can't just look at crude. You have to look at crude and products. What's the total draw in petroleum inventories worldwide? What's the total loss in total petroleum supply worldwide? It's already 1 million barrels a day. So how come people aren't talking about this? Because the way that people are thinking about this is that if Russian product supply is down 1 million barrels a day and Chinese demand is down by 1 million barrels a day, it all kind of just got smoothed out for the last 2 months. But once Chinese demand comes back online, Russian products continue to drop, and the Russian crude potentially starts to drop, is when you will really see the big impact, the big perceived shortage that's out there, and the big issue that I think is going to be here in the summer, and why I am so bullish on my oil equities for this summer specifically, is because the Russian issue is not how much crude is Russia exporting. That it can't be simplified to that one thing. We have to be looking at the overall Russian exports and what's going on that have mitigated the impact of this loss of supply for the last 2 months. When we look at it with those three factors in mind, the whole equation changes dramatically as to how this summer is going to look, especially with what the demand is showing, that the jet fuel demand is going to increase by 500,000 barrels a day per month for the next 3 months. When we're seeing Indian demand hit record highs month after month, you take all that into one. And when I say it's setting up for a very bullish summer, I truly mean it. I see no way that oil can drop below $100 a barrel for any sustained period of time. And the way that I'm looking at the data, it's heading much, much higher. Just based on kind of what I'm seeing of this, the elephant in the room, how it's going to materialize over the next couple of months, especially as the demand comes back online. There's a comment here. Yeah, so Reuters has been talking about the oil output falling by 17%. So again, they're again focusing on crude and how much production of crude oil and how much production or export of crude oil. Very few people are talking about the products and how far the product exports have dropped, how their refining capacity has really dropped for whatever reason within Russia. So I'm focused more on the product side. I'm focused more on the overall export. I'm not really paying attention to the crude export as its own thing because it doesn't matter. We have to look at the entire slate of petroleum and kind of where it goes from here. So again, diesel, naphtha, gasoline down. The discounts of Russian crudes are getting bigger and bigger, and they're sustaining there. You have the Urals grade, the CPC grade out of Kazakhstan. Some of the other blends. We look at Urals grade is now down to minus $35 a barrel. So when India and China and the emerging markets are buying this crude, they're only paying $65 a barrel. There goes the demand destruction argument right out the window, just with that, let alone all the other factors why demand destruction is not going to be a big deal, even with a stronger dollar and even with a rising oil price environment. Any barrel of Urals grade crude that goes to India is selling at $65 a barrel. They have their own refining capacity. They can afford to reduce the taxes on gasoline. They can afford to give subsidies. It's not going to change the fiscal deficit of the country because of all these background factors that are going on. China is the same thing. This is your Russian supply. This is what the Russian oil fields look like, the new ones. When Exxon and Shell and whoever else is pulling out, you can't just jam a Chinese company in here or some Middle Eastern firm and expect them to operate these fields. They're not easy fields to operate. Like this is not the North American model or the Middle Eastern model. This is offshore with wind chills of minus 60 degrees Celsius in the winter. This is harsh environments. There's a reason that people from America and Canada go to work on these fields. They keep pulling these expats to work there. The expertise, the labor, the engineering, etc. required. So does Russia have the capability to run their own fields? Yes. Does Russia have the capability to run their own fields, maintain them, expand production, and manage 10 million barrels a day of production? Not a chance. There is no way that that's going to happen. So if Russia was a 1 million barrel a day producer, sure, they could manage it on their own. But 10 million barrels a day, there's not a chance that that's going to happen, or any firm can help them with the amount of expertise that's required for these. These are probably projects that are $10 billion plus. So I always like to keep that in mind as somebody who's worked in the field. This is not easy work, and this is not work that you can just train somebody in a week to start doing this kind of work. So I think there's going to be an impact as the services come out, as the labor comes out. Even if they have the technology, a lot of this technology offshore drilling and production, you can't just copycat it. It requires a lot of actual work experience, having done that sort of work. So I'm not saying that their oil industry is just going to collapse overnight, but you're definitely going to see an impact, and probably an impact that's bigger than what people are telling or predicting. Because I've heard a lot of this statement that Russia is going to pull the Chinese expertise in to help them operate their fields. And if it was 1 million barrel a day, maybe, but not 10, 11 million barrels a day, and all the new projects coming online. That's a lot of manpower. That's a lot of expertise and people and money to make up for. So again, I may end up being wrong. I may end up, being right on this, but I'm more of the opinion that the production is going to decline naturally, even if they can find a way to sell it, which it doesn't sound like they're having a very good time as we go into the rest of the summer. The new projects in Russia, a lot of the new projects and unsanctioned fields have break-evens above $50 a barrel, some even above $60 a barrel. I want to clarify here, this is not operating cost. This is the break-even, which means all the money they got to put in upfront is being amortized over a certain period of time. So, okay, if WTI is selling at $100 a barrel, Russia is taking a $35 discount, so they're only getting 65. These projects don't even make sense anymore. To sanction them and to build them out, to spend billions of dollars up front, and then operate them in these harsh climates to make $3 or $4 a barrel, it makes no sense. So any future outlook of where Russian production is going and these projects coming online may not be accurate anymore. They're not going to sanction these projects if they only make $7 or $10 a barrel. It's just not going to happen. So again, something to keep in mind. Russia was touted as a big source of future production. I believe it's Ed Morse with CNBC, if I'm not wrong, don't quote me on that, but who was talking about there was going to be 1 million barrels of Russian supply come online extra this year. Russia might lose 1 million barrels just in natural decline. So that's a 2 million barrel a day shift, which we got to think about and how we're going to deal with this going forward. Yeah, so that's a great point. So there's a possibility that China and Russia do it just for national security purposes, not for profit. They could. Are these projects going to come online in the next 5 years? I don't think so. Are they going to get even more delayed with no Western expertise, service rigs, drilling rigs, engineering, parts, etc.? Probably. So even if Russia and China make some sort of deal that China wants the oil for their own domestic consumption and they're willing to subsidize the cost of it, it's still going to take them 3, 5, 7, 10 years to get these fields online. So I'm not really concerned. And I think the break evens are just going to get higher and higher as they require more expertise, more time. They need to have their own service rigs. They got to build their own equipment. It's just going to take more and more higher oil pricing to get these projects sanctioned. Libya, another one that's been in the news lately, and people are just assuming that Libya is good to go for its 1 million barrels a day. It's good to go. Look how fast production dropped in Libya once the rebels or whatever you want to call them. I don't understand the geopolitics that well, but once they took over, production dropped from 1.2 million barrels a day to 100,000 in like 3 months. What's going on right now? They're having issues with elections. They're having issues again with production, people taking over fields. It's been getting more and more in the news cycle. We haven't seen any major impact yet, but we did see a couple fields get shut in last week, 2 weeks ago. What if it gets just a little bit more serious? We could see another 1 million barrels a day come offline in 3 months. It's happened before. It happened 2 years ago. This isn't something that happened 40 years ago that I'm talking about. So, again, sleepwalking. We are ignoring these things, that taking them for granted. People take Kazakhstan for granted, and Kazakh production was down 500,000 barrels a day in March and April for parts of the month. A lot of the catalysts that I see are bullish in terms of oil supply demand. As an investor, these sorts of issues, you can ignore them until you can't, and then they're right in your face with a 1 million barrel a day supply loss for 6 months or all summer kind of thing. What is the difference in sophistication between North American and Russian, Indian, Chinese firms? So there's two big things. One is the quality of the equipment. A lot of the drilling technology has gotten very advanced in the last 10 years, especially horizontal drilling, offshore drilling, etc. So not having the right equipment that can deal with all this is going to be one of the biggest issues. In terms of the expertise itself, you will find this very often in the oil and gas industry, is people don't get paid for what they know or what they can tell you. They get paid for going through situations. So when there's a big fire, when there's a big blowout like Deepwater Horizon, when there's a big project that needs sanctioning, people will pay you in the oil industry for having run these projects before, as in actually having led them, project manage them, and bring them to development. So North American companies and expertise has a lot of expertise with that, with these big projects. The Russian, Indian, and Chinese firms, they haven't really brought these massive projects into development on their own accord in the past. They're relying on American engineering and Canadian labor and field operations people. So doing anything like this the first time gets way more complicated, especially with how risky the oil industry is and how precise you need to be to bring these projects online and have them run properly. That's not to say that they can't do it. I just think they can't do it for 10 million barrels a day of production and the new projects coming online. Let's talk about America specifically. America is the biggest, now the biggest producer, I guess, of oil, roughly. So oil production has started to flatline. We see that we kind of hit a high here in December, and since then it's basically been flat for the last 4 months. Keep in mind that the world is expecting American oil production up at least 500,000 barrels a day, plus the condensates on top of that. That's the call on American production. Year to date, we really haven't seen any growth so far. I know there's been some weather impacts and some other stuff, snow and whatnot, but on the aggregate, the production has not really increased so far. The rig count continues to go up, but this is the American rig count over the last month. It's dropped. The number of rigs drilling in America over the last month has actually dropped. With WTI averaging $105 in April, roughly 105, 110, the supply response is just not there this time around. You're not seeing people going crazy and starting to drill a bunch of wells, whether that's supply chain, whether that's capital discipline, whether that's lack of acreage. you can put whatever reason you want on it. The reality is rigs have dropped in April so far. I know the Baker Hughes data doesn't really mesh with this fully, but the point is we haven't really seen a huge increase, and we've actually fallen off the trend of adding 30 or 40 rigs a month. That's not been the case for April thus far. So the question comes to DUCs. DUCs are drilled uncompleted wells. They are a savings account that a lot of oil companies keep. They'll drill the wells, but they won't complete them. Complete meaning hydraulically fracturing them or stimulating them in whatever way. They won't complete them, they'll just drill them. They stay there. They're like a savings account, a reserve, if you will. So the production that's been increased for the last year or so, you might say, well, they're able, let me just go back here. So I want to go back to, yeah, I actually lost the data here, but this entire production increase for the last year, we see the rigs going up, but it's been strictly from DUCs being drawn down. Companies were completing way more wells than they were drilling. For the last 18 months now, we see here the number of completed wells in blue, the number of drilled wells in red. 2018, 2017, 2019, we were drilling more wells than we were completing. So we were building up this reserve of extra wells sitting around that have already been drilled and that don't need any casing because they've already been cased. For the last 18 months, completing way more wells, drawing down this reserve of extra wells. In some cases, 300-400 wells a month. It became pretty big. So why am I talking about this? Because the DUC inventory has gotten very low now. We were able to use this inventory to keep American production flatline / rising. No longer the case. We're now running out of DUCs. When we look at just the three big oil plays, Permian, Bakken, Eagle Ford, we have roughly 2,500 DUCs left, the three big oil plays. This is just another way of looking at the data, the latest data. Again, Permian, Eagle Ford, Bakken, roughly 2,500 wells. Why is that important? Because 2,000 of them are dead. Dead DUCs are wells that were drilled in the wrong zone. They did not find economic oil. They screwed up the drilling and they sloughed in something. The well did not produce enough oil to make it worth it. Those we call dead DUCs. We see that the number of dead DUCs kind of stays flatlined because they're dead, so they're uneconomic. So out of 2,500, 2,000 are dead as of January. This was information in January. If we go to today's information, 2,500 of these are dead DUCs. Okay, so there's 2,500 DUCs left in the major oil regions, and 2,500 are dead DUCs. That means the abnormal number of drilled uncompleted wells sitting out there has basically gone to zero. I'm not going to pat myself on the back, but there's a lot of people who have been saying this since January. Tom with Flow Partners being kind of the main about this DUC issue, going really deep into the data. We don't have DUCs left anymore. That's the reality. So when we look at future production increase or production in America specifically, the impact of the DUCs for the last 18 months now has to be taken out of the equation, and is going to catch a lot of people off guard as to what's happening here, and I'll talk about that here as we go. The selective picking of rigs, we see that when COVID first hit, they dropped the lowest efficiency rigs, they dropped the lowest efficiency crews, and they were running with the highest efficiency rigs. And the average efficiency of each rig started to go down as we added more and more and more rigs, to the point now every rig we add today is basically the lowest quality rig, the oldest rig, the one with the worst equipment, the oldest technology, the newest rig crews, the most inexperienced rig crews, etc. So when we add 40 rigs today, it's not the same as adding 40 rigs a year ago. And we have to keep this in mind. The lack of efficiency is just getting worse and worse. So the 40 rigs we added last year, we now need 60 rigs this year to make up for that sort of drilling efficiency and new production. Again, stuff that no one really mentions when they talk about American production. They think it's all the same. All rigs are the same. It's obviously not the case, as we see here. We see the DUC inventory coming down as well. And so what are the experts telling us? What is Rystad telling us? Rystad figures that American production will increase to light, tight oil production, as in shale, will increase from 8 million barrels a day today to 16 million barrels a day in 2030. This is the exact forecast that they're sending to the US government. This is the exact forecast they're sending to all the newspapers and people who don't understand oil. They keep relying on this data that, oh, why are people like Shabam talking about the impending oil supply issue when we can just drill 8 million barrels a day more of shale in the next 10 years? That's what they're telling us. And this is completely wrong. And I'll actually back it up why I think so, because it's important. If I'm gonna take on a big firm like Rystad, I think the data needs to show why this is pretty lazy analysis, in my opinion. That's what they're saying about the Permian. They're saying the Permian is going to go from 5 million barrels a day to like 9 million barrels a day in the next 10 years, or 8 years now, I guess. I don't think that's accurate at all, based on some of the trends we're seeing, some of the CEOs' own forecast on their own inventories and their well productivities. So this entire production increase from, let's say, August of last year to today is roughly 300, 400,000 barrels a day. And people are allocating that to shale, that look, shale production is growing. So we've added 400,000 barrels of shale production in the last 9 months. Look at conventional production. Conventional is non-shale production, has gone up by 300,000 barrels a day in the last 9 months, maybe even more now. So is it really shale that is responsible for the increase in oil production in the US? I would say some of it, yes, but the majority of it is actually conventional old wells being brought back online and are responsible for it, which means that shale itself hasn't actually done anything in the last year. The production hasn't moved very much at all. These conventional wells are not new drills, they're reactivations and service rigs. So they don't show up in the drilling rig counts. So it's getting complicated here, but the point I'm trying to make is we've added all these rigs, we've drawn down all these DUCs, and strictly shale production has basically done nothing. It's been conventional that's been responsible for the increase in overall American production. This is from Shell's latest report. Their offshore platform increased production by 80,000 barrels a day in Q1 versus Q4. So how much did American production increase in Q1 versus Q4 of last year? 0, maybe 100,000. So all of that 100,000 can be allocated to the Gulf of Mexico, which means that shale production was actually flat or declining with all the DUC drawdowns and about 650, 700 rigs going. What does that set us up for in the future? I think it's important to take these things into account. Just allocating all US production to shale is a completely wrong way to look at it. There's proof right here that conventional was responsible for the increase last year. And conventional has been responsible for the increase in Q1. Where does that put shale, the big growth engine, the big one that people are relying on to add 500,000, 700,000 barrels a day this year? It puts it in a very bad spot. And when I say these things out, a lot of people say, well, you're completely wrong, and shale can increase production by this and that. Well, show me. Which companies in shale have increased production so far this year? Which companies increased production in Q4? Add them up. Does it get you to the 400,000 barrels a day? I would say no. Cumulative, you can't add the companies and show me that the shale production went up to that, because it didn't, in my opinion. A little bit more on the DUCs. Again, this is work from Tom at Flow. Back in 2022, when it first started, his team claimed that there was 254 excess DUCs. We're now in March. These 254 are gone. We have 0 excess DUCs left that are just sitting around waiting to be completed. Frac spreads. What happens if you were completing more wells than we were drilling? What happens when the DUC count becomes 0 or close to 0? Your frac fleets should fall. What are we seeing? Frac fleets falling. The frac fleets have started to fall and normalize. They're no longer on this uptrend. Just as a comparison, pre-COVID, we were roughly at 400 frac fleets. We're now maxed out at 275. The Permian has lost 23% of its frac fleets in the last 3 months. What does that tell us about the Permian frac, the DUCs out there, the extra ones ready to be fracked without the drilling? We are running on fumes on the frac, on the DUCs. There's other issues with labor, supply chain, Permian production not looking very hot going forward. North American frac spreads basically flat. In a pricing environment of $90 oil, $100 oil, frac fleets are flat or even dropping. Should send off warning signs and alarm bells, but it hasn't. People are just not paying attention to this oil industry. There's very few people who care. There's very few people who can understand this sort of data or even care to understand this sort of data. As an investor, that's setting up very good for an oil investor into the future. For the average consumer, not so much. EIA data is bad. It is absolute trash. Like, the Texas Railroad Commission is reporting their production numbers. The EIA is getting further and further off it. Same with the New Mexico regulation body. The EIA is reporting their own made up numbers, really. Something to keep in mind. When we look at the weekly EIA reports, they've been wrong since December compared to the EIA 914, which is the granddaddy of the US production data. The weeklies are getting more and more off what the monthlies end up at. So if there's a 300 barrel a day gap there for March, let's say, and February, what's the gap now? Is it getting worse? Is their data actually even trending the right way? We're losing more and more faith in the EIA data as we go. So again, something to watch. The actual data versus what the predictions are and what the EIA is telling us. Here's a prime example. The EIA releases a DPR report, a drilling productivity report, that every month you will see on the headlines. EIA predicts shale production is at record highs. It was the same headline in January, the same headline in February, and I bet we'll see the same headline as we go. But what's the reality? What's actually happening? So in their February report, they predicted March production at 8707, 8.7 million barrels a day. when the March report came out, the March number came in at 8.6 million barrels a day. So they lost 100,000 barrels a day of predicted production in 1 month. Okay. Is that a big deal? Well, let's look at the latest DPR report that came out. They predicted for April 2022, 8.7 million barrels a day. The latest DPR report for April 2022 came in at 8.5 million barrels a day. It's now gone so bad that they're losing 200,000 barrels a day of predicted production in just 1 month. That's how bad their estimations and predictions have gotten. And people are going to give me flack for this, but when I say the EIA data on the DPR is complete trash, I'm showing you it's so far off. It's embarrassing. If you can't even predict production for next month, you're off by 200,000 barrels a day. Something is seriously wrong with your modeling, forecasting software, or whatever's going on. And now they're predicting May at 86.49. How far off is May going to be? Will be interesting to watch, and I will cover that in the next macro outlook. So I look forward to the next DPR report. US rig counts, it's been the private companies that are adding. The public companies have been pretty stable on the rig counts. They don't care. It's not their job to support the American consumer. It's not their job to provide cheap energy to people. They've been bashed on and called polluters and called all sorts of things. They've had funding pulled from them. Why would they now go out and listen to the government and start subsidizing the American consumer? That's not their job. So I think producer discipline is here to stay much more than people think. Of course, companies are going to add rigs, but they're not just going to go crazy either. Private equity commitments in the US. In 2017, 2016, the glory days, there was one new private equity funded oil company upstream every 3 days. One new company every 3 days getting $200, $300, $500, $700 million. 2020, less than one a month. It went from one every 3 days. 2019 was one every 10 days, 12 days. 2020 was less than one a month. Private equity is no longer cares. They don't want to lose all this money from lying management teams talking about their acreage. They got 40 years of inventory. It's all BS. And I'll show you why with actual data. Cheap debt. What did cheap debt do to the oil production profile? It completely destroyed it. The shale companies got so much cheap debt and cheap equity that they jacked up production more than what a natural cycle should. What did that do? People no longer invested in long cycle projects. So usually you would have long cycle projects like the oil sands, like Kazakhstan, some of the Middle Eastern fields coming online every few years. They were no longer economic because of the short cycle shale access to debt. And this is the production profile you will now see. Instead of a smooth up and down like a conventional reservoir, you will see this massive jack up, and then the decline rates kick in on these unconventional wells, and they absolutely hammer production. So the Rystad prediction, in my opinion, is going to be so hilariously wrong. It's not even going to be funny. There's no way shale can produce 18 million barrels a day, or even half of that 10 years from today. I'm willing to put that on a recording. Can they have some sort of enhanced oil recovery method that totally changes everything? Potentially, yes, because the recovery factors of shale wells are so low. But until that happens, I don't think it's right to be making random predictions as if the reservoir is unlimited. Another problem for shale is the increasing gas oil ratios. They keep getting more and more gassy to the point that the wells now can be classified as oily gas wells. They're not even gassy oil wells. They're just drilling gas wells with this condensate in there. The Eagle Ford is the biggest for this, but some of the Permian in the Lea County, Eddy County, maybe even Loving and Reeves, are basically gas wells with oil streaks on them. Apache recently got in huge trouble for lying about their well results. I think you'll see more and more companies getting affected by this issue, over promising by large margins on their acreage and production. What are the economics of gas versus oil? Gas actually still has a lower netback per BOE, but it's been getting better and better. And yeah, it's more volume. When the company says they got 500,000 BOEs of production out of the Permian, at 40% gas, that's different. At 60% gas, it's completely different. Exxon is one that's completely lying about their gas percentage. They say they're going to increase production 10% until you realize that's a BOE increase and it's all gas. It's not oil production increase. And the analysts are falling for it every single time. It's just funny. Flaring, another issue. The public companies in the Permian have gone hammered to reduce their flaring of gas and just wasting it. What are the private companies doing? They keep flaring away because they don't care about ESG. They don't care about shareholder commitments or anything like that. So as you see these companies get bought out or more pressure put on them, and if they don't have offtake for their gas production, they're going to have to shut wells in or slow down their drilling program. And if they get bought out by public, more money will get put in to reduce the gas flaring, which is, it's a lot of work to put in these compressors and gas offtake and whatnot. Isn't gas worth too much now to flare? The private companies really don't care, to be honest. They're after the oil. They will flare whatever gas. If they can't offtake it, they'll just vent it and flare it. It's the public companies we need to watch. As we get more consolidation, you'll see better and better ESG metrics. And it's a headwind. The point I'm trying to make is it's a headwind. It takes away from your drilling development plans and production increase plans. You have to spend money on building gas pipelines and offtake and whatnot. Reserves, the US uses up 10% of the reserves every year. Look at Russia, look at Canada, Venezuela, Iran, 1 to 2% of the reserves every year. That's a pretty safe place to be. That means you have a lot of reserves compared to your production. The US, almost 10% of the reserves. So when you see CEOs of huge Permian companies coming in and telling you, look, we don't have inventory to increase production. We can keep production flat for 10 years, or we can increase production by 15% every year and be out in 5 years. The reserves just aren't there to keep increasing Permian production. The management doesn't care. They want their job for 10 years, not for 5 years. They're getting paid no longer on production growth. They're getting paid on cash flow. Do you think they want to increase production if Mr. Biden goes out and starts telling him, do this, do that? They don't care. They want their own money. People, it's human nature. People react and make decisions based on what's best for them. And if they can make more money by milking this for 10 years, that's what they're going to do. If they can get higher bonuses by having higher cash flows as opposed to higher production, that's what they're going to do. We have to think the way these execs think to understand why they're not reacting to higher oil prices. The Permian, the US Geological Society told us this is what the Permian is, this outside limit. The green are the wells and the blue are the wells. That's what the actual Permian is. It's less than half of what they told us it was. If this Permian had oil in it, economic oil, it would have been drilled. There would have been some wells, at least some exploratory wells. There aren't. So what does that mean? That means that in 2017, people thought shale was a 40-year reserve. Cut that in half right away because the acreage just isn't there. So it's a 20-year reserve, okay? it's a 20-year reserve at current pricing or at current production. If they start ramping up production to doubling it as Rystad predicts, it's going to become a 7-year reserve. So the geologic data agrees with some of the production constraints. And you can throw whatever number you want on a prediction. If we had the money, we can do this or do that. But if the physical oil isn't in the ground, you can't just produce oil drilling locations out of thin air. So, a lot of financial people don't seem to understand this. They just think that if we had the money, we could go out and ramp up production for the next 40 years. It's not the case because the oil isn't even there to begin with. Decline rates. As the wells are getting longer, as the wells acreage is getting worse, the decline rates are getting worse. 6 years ago, the average decline rate of a well in the Bakken, first year, was about 45%. Now it's 60%. Okay. So any new well that's drilled in the Bakken is going to decline at 60% in the first year compared to 45%. Aggregate that to the entire Bakken new production brought online. Sounds like a treadmill, doesn't it? You're having to drill more and more wells every year to keep your production flat. The decline rates are accelerating, not just in year 1, but in year 2, year 3, year 4, year 5. Not a good look at all for shale, for oil supply going forward. When I say the Bakken is a mature declining reservoir, you can see it. The wells themselves are just poor quality. They're declining more and more and more. So the 1 million barrels a day of Bakken production, we only needed X amount of rigs to keep that flat in 2016. Now we need more rigs because the decline rates are getting higher. The wells are getting worse. The gas oil ratios are getting worse. So people have heard me on other calls. They ask me about the Bakken producers, and I say, I'm not investing in anything in the Bakken. This is why. The wells are just absolute garbage at this point. Are there sweet spots still left? Yes. But I'm talking about the production as a whole, as a macro level perspective on it. I'll ignore this. I'll leave this for now. Actually, I'll talk about it. So the US was a net importer of oil and products. It slowly started exporting more and more to the point that they became a net exporter of oil and products. And then the trend reversed. Because of internal consumption increases and because of production losses within America, the trend has seen a clear reversal. The last couple of weeks have seen exceptional exports, which is kind of messing up the data here. But I would expect this to go back into this sort of range here. What does that mean? That means 1 million barrels a day of product and crude that was previously available to the world is now being consumed within America. So America's job as an oil exporter, as subsidizing the world, it's pretty much ended. You can't rely on America as being the marginal supplier of worldwide oil anymore. Okay, does Bakken gas actually increase? Yeah, so I will talk about this as well. Thanks for the question, Matt. Reinvestment rates down. Nobody's been investing in oil. It's pretty obvious. We were investing 140% of our cash flows in 2016. It's now down to 50%, less than 50%. Capital discipline is here. Projections for the annual spending on oil and gas in the future, it's projected to stay low. There is no long cycle projects that people are really investing in. They say, whatever, screw this. We want a few years of high pricing. We want to pay our shareholders. We want to pay ourselves. We want to replenish inventory. We want to, make some money here, and then we'll think about bringing more production online. Why bring a bunch of production online and start selling oil at $50 again? It doesn't make any sense. And it seems like management teams agree. Again, capital was 3 times larger in 2014 than the guidance for 2022. 3 times larger. Oil wells decline. Oil production needs maintenance. You can't just produce forever by not putting capital expenditures in. So this is going to come back to bite now. The 7 years of underinvestment is going to bite big time. Postponements of investment decisions because of low oil pricing. We have lost 10 million barrels a day of 2024 supply because projects got canceled, because shale came and started bombarding Texas and New Mexico with oil wells that they were willing to sell at losses just for the sake of production growth. We've lost 10 million barrels a day of supply that should have been online by 2024, but isn't. Same with LNG. We've lost a bunch of LNG production. That's what happens when you mess with a cycle of oil, a 5-year cycles of oil, when you mess with it with money losing Ponzi schemes like shale, you don't care about making money, you just care about production. It has a big impact because oil, you can't invent oil out of thin air, and we need oil, and we haven't put the money in to get that oil. So this stuff is all going to come to fruition. It's going to slap people right in the face with the reality as the years go on here, 2022, 2023, 2024. Sustained higher prices. Yeah, great comment. And the 3 words, that's all we need. Okay, are there any questions before I go into the other supply, the non-American supply, if you will, or the non-shale supply? No, okay. Conventional production. 60 to 70% of the world's current production is conventional production, which means non-shale, non-oil sands. It's the old school wells with very little downhole stimulation or anything required. It's your water floods, your CO2 floods, etc. Conventional production follows the Hubbard linearization. What does that mean? That means that when a conventional field produces half its recoverable reserves, it goes into terminal decline. So you increase production. When you've recovered half the recoverable oil in the ground, your production goes into terminal decline. Once you decline 50, 60% from the peak, you can maintain it there with water floods, CO2 flooding, enhanced oil recovery, huff and puff schemes. There's all sorts of EOR stuff, but you're never going to be able to maintain the peak, is the point. Yeah, I'll talk about the longer laterals and the decline rates here in a bit. What part of the lack of investment is upstream? There's a lack of investment in everything. Upstream, downstream, refining, tertiary, LNG, water flood, maintenance, everything. Huff and puff methods are where you inject high pressure gas into the formation to try and get the gas into the oil, and then you use that pressure to re-energize the reservoir, and then you produce from that same reservoir to try and get more oil out using the natural pressure of the formation. There's all kinds of stuff going on. So natural gas potential in the Haynesville, I honestly don't know much about the US gas reservoirs. I do know that they are massive and they have a very cheap supply cost. So if the right export terminals can be built, we can definitely have more gas production in the US to feed the world. Yeah, so, okay. Let's look at Ghawar in Saudi Arabia. We had the best oil reservoir the world will ever see. This is the king, the behemoth. It produced roughly 5% of world oil production just on its own for like 30 years in a row. Amazing. Here we see the wells on the right in red. The water flooding wells are in blue. This picture is from 20 years ago. You can see how jammed the wells are in already 20 years ago. There's very little space left to drill new wells. And the theory was that in 2005, Ghawar had produced half its recoverable reserves and was going to be on this terminal decline. What did Saudi Arabia do? They brought in a lot of engineers, they brought in a lot of expertise. They started doing horizontal drilling, they re-optimized their water flooding scheme, and they were able to keep production maxed out at the peak for an extra 10 years till 2015, 2014. I don't have the exact date. This is my speculation and my understanding. And then in 2015, 2016, the field went into its terminal decline. In 2020 or 2019, when Aramco came out with their prospectus on the Aramco shares, they said Gawar was producing 3.8 million barrels a day. So let's take this predicted curve, move it up 3 or 4 or 10 years, go to 2019, and we end up at that 3.8 million barrels a day, roughly. That's exactly where we end up. Some of the latest numbers have predicted that Gawar is at 3.2 million barrels a day today. So another 600,000 barrel a day loss. Okay, so let's take 2022 and move the curve up 3 or 4 years, and we have 3,200 barrels a day. That's exactly where we are. Can Saudi Arabia maintain Gawar by letting it relax and then reproducing from it, by drilling more wells, by doing water flooding, CO2 possibly? Yeah, they can, but the decline is going to happen anyway. They aren't able to maintain the peak production. Okay, so why am I mentioning that? Because every Saudi Arabian field is in the same position. The fields that were discovered in the 1960s and 1970s are all in terminal decline and declining without massive money being put into water flooding schemes, into new horizontal drilling. These fields are going to decline. They're going to decline anyway, even if you put the money in, just because of the way oil reservoirs are. They're not these massive pools of oil that just keep refilling. Once you produce that oil, it's gone. So there's 10 million barrels a day in terminal decline. Here's Kuwait. Kuwait in 2017-18 was 3.15. In just 1 year, they lost almost 10% of their production. 2019 again, and 2021, they were at 2.5. So Kuwait lost 600,000 barrels a day of production capacity in 4 years. Extrapolate that to 60 million barrels of world conventional production, losing 3% a year, 4% a year, and not enough capital being put in to maintain production. Then add in all the demand things we've been talking about before, add in the Russia situation, add in the shale situation, add in the inventories are at record lows and continue to drop. How can anyone say to my face that oil is going to drop to $60 a barrel or $40 a barrel? This is not the same cycle as it ever was. This is a complete undersupply with declining investment at a time of emerging demand exponentially increasing while sitting at extremely low inventories. It's not the same as any other cycle. Saudi Arabian rigs, this is not an accurate number. This is from Baker Hughes. It's not completely accurate, but it shows you that in 2005, when the book came out calling for the end of Saudi oil, they jacked up their rigs, kept production flat, a lot of horizontal drilling, water flooding. I have never worked in Saudi, nor do I know this for a fact. I'm telling you what I think. This is my opinion of what's happened. 2010, 2008, some of the financing dropped, so they lost rigs. 2010 to 14, prices were high. Look at how many rigs they required to keep their production flat, from 10 rigs to 70 rigs. And they kept a bunch of DUCs, they did a bunch of other work. And now the rigs have been consistently lower for a bit. So one to watch closely what's happening. OPEC rigs are still very low. Just like America, OPEC is in no hurry to start jamming away production and get market share or whatever. They don't really care. They're gonna slowly bring their rigs back on. No rush. OPEC plus oil rigs have actually declined so far this year. So when you add in all of OPEC plus, the number of rigs running at $100 oil environment is dropping. What does that tell us about where OPEC's mind is? Are they in a mad rush to increase market share, increase production? Doesn't look like it. There's only 2 countries that are hitting their targets on the OPEC production, Saudi Arabia and UAE. Everyone else has basically failed. They are having production issues, repair, maintenance issues, geopolitical issues, lack of good fields, lack of development, missing big time. So the OPEC increase of 400,000 barrels a day every month is under massive pressure to show me the money. Can you actually walk the walk? So far, Nigeria, Angola, some of these countries are really missing their targets by more than 20%. Cause for concern. Even countries like Iraq and Kuwait are now starting to miss their targets by 3%, well, 2%, 3%. Stuff to think about. Russia is going to completely miss the target as we go on here. OPEC rigs, land rigs. Sorry, the Twitter space just crashed. The OPEC land rigs, not close to where they were before. The OPEC offshore rigs, very low. OPEC offshore rig exploring for gas is down to 2 rigs. Basically nothing. It was down to 1, looks like. So where is OPEC then? We've talked about shale. We've talked about Russia, Libya. Where's shale? Or where's OPEC? OPEC exports have really done nothing in the last 6 months. They're basically flat. The amount of oil that OPEC is exporting, excluding Iran and Venezuela, is basically flat. Where is the 400,000 barrel a day increase? It's either gone in production misses or internal consumption going up to the point that they can't load the oil. They have to use it internally and they can't export it. Pretty interesting trend here that's starting to develop in terms of how much crude OPEC can export. Here's the same graph using OPEC plus. They've lost about 3 million barrels a day of export capacity in the last 4 years. And it seems to have plateaued. It's declining. If the market is expecting OPEC plus to increase exports and make up for the supply shortfall, they're going to be totally wrong here as to what's happening. Countries like Nigeria and Angola have had 6 months of high pricing to get their production back up, to get their fields running. They haven't been able to do anything, it seems like. So supply is materially damaged. This is not 2008. This is not 2014, when 1 million barrels a day of supply can come online in 6 months. We are seeing declining reservoirs along with productivity issues in shale, all coming to a head at a time of massive demand increase projected over the next 3 months, let's say. Saudi production is basically maxed out. We see we're running where we were running the max sustained production. Can they increase it to 1 million barrels a day for 3 months? Yeah. Saudi does this thing where they relax certain fields and they produce from the other fields while the relaxed fields are kind of regenerating their pressure and production capacity. So could they increase it? Yeah. Do they want to increase it? Highly doubt it. Is the crude quality, as Dr. Al-Haji says, is the crude quality of that reservoir good? Probably not. It's very heavy, high sulfur oil, probably, that maybe can't be processed as easily or can't be processed by all the refiners. So it's not high grade oil. It can be used in a huge pinch, but not likely to be the desired grade at all for the markets. What is Saudi telling us? Saudi imports about 80% of their food, food needs for the country. To pay for higher food pricing, they need to increase the OSPs on the oil they sell. The two aren't necessarily linked. but they play a factor in each other. So when Saudi is increasing their prices at $9 above the benchmark, and they still feel comfortable that they can find buyers for this oil, that should tell you that the market is extremely tight. This is the highest OSP that they've ever seen. We're having the new OSPs come out probably early May 5th or May 7th. So we'll see what they're thinking right now, but they feel comfortable they can sell their oil at $7, $9 above the benchmark for such a huge exporter. They're telling you the market is extremely tight. The buyers have no option but to buy it and pay the higher prices. It's just the reality of the market. Russia, I used to share this slide in the pre-February macros that Russia is going to increase their oil production for the next 7 years. It's not going to happen. The undeveloped fields are not going to get sanctioned, so take the blue part out. The greenfield projects are under risk. Are they going to be completed? So take a bit of this green part out. You end up with a flat to declining profile on your existing production moving forward. There's a comment here that didn't they price themselves out with these OSPs? Possibly they suffered a little bit of a demand decrease, and you might see these OSPs come down a bit. But if they only price themselves out a little bit with the OSPs so far high, maybe they were just testing the market, seeing how high they can go, and then they'll bring it down to this $6 range or $5 range. So we'll see how this goes. North Sea, what a great timing on this question about Norway. So this is Norwegian oil production in blue, conventional declining, terminal decline. The Johan Sverdrup field was brought online in 2020 and 2021. It increased production a bit, but look at where the profile is going from here, all the way down. The North Sea has seen some capital flow back in. So maybe the decline is not as big, but it's still going to lose 1 million barrels a day in the next 10 years. That is fact. If it loses 750, it's still a loss. The point is it's not flat and it's not increasing. So not only is the demand going up worldwide and we're not bringing on new supply, the existing supply is now starting to decline at these massive rates. Where does that put us for supply-demand imbalance going forward? What happens to your SPR is completely drained 3 years down the road? You know, things to think about, and how high oil prices can be sustained for how long. This is the most promising wells in the North Sea in 2020. What they said, these reserves are our most promising reserves. 6 out of the top 8 biggest reserves came out dry. They did not find oil, or they did not find commercial quantities of oil. It's getting harder and harder to find oil. The easy supply is all gone. The hard to find supply is all gone. We're now looking for stuff in brand new exploratory fields. We're stepping out on the existing fields. We're increasing our risk of not finding oil. So even if you throw money at the problem, it's not going to fix it. So as an investor in a non-exploration company, some of the Canadian producers that have 30, 40, 60 years of reserves, they don't need to go out and take these exploration risks. I feel very comfortable. I sleep very well at night. On days that things draw down 6, 7%, doesn't bother me because I know. And again, this is not investment advice. This is my opinion. I have no issues with the way the oil macro is looking. Even if you throw money at it, even if the US government and the Norway government throw billions of dollars, the oil just isn't there. It's getting harder to find this oil, which a lot of people ignore this fact as well. They think if you throw money at it, you can just keep finding more and more oil. Not the case. I'll talk about Guyana and West Africa here in a sec. Norway supply, the green is oil. You see that conventional graph that I showed before? It peaks, you have a 50% drop off the peak, then you can maintain it there for a few years with EOR and further drilling, but you will never get back to the peak. That's just the way oil production are. They're not replacing their reserves. On the liquid side, they haven't really replaced the reserves that they're producing. The last 3 years have been below 100%. Not a good look. Gas has been below 100% forever. If you don't replace reserves, how are you going to keep producing for 5, 7, 10, 15 years? Mexico, the same trend. Conventional oil hit its peak, declined to about half the peak, and now it's being kept there / continually declining. Another field in Mexico, Cantarell, same thing. They overproduced this field with nitrogen injection and pulled too hard on it, and the entire field collapsed on them. Worldwide conventional, we hit peak conventional production in the early 2000s, and we're in this terminal decline now. So 35 million, that means it's going to decline 17 million barrels a day, and then you might have a chance to keep it flat there. In the case of American conventional, it had to decline 80% before they could keep it flat there. It just kept declining. Right here, USA. So it's not easy to keep conventional production flat. It's a rough process and a lot of money, a lot of repairs and maintenance. Brazil keeps getting talked about as a big producer. The Brazil fields are not that good. They had a big funding in 2010 to 14. The projects came online because they're long cycle projects. They take 3 to 5 years to come online. They came online in 2016, 2018, 2020. Brazilian production is up, but Brazil seems to miss every single one of their projected targets for production. They had all this money pile in 2008 to 2015. It's all gone. There was a recent news release that came out that Exxon is having trouble finding oil in Brazil. So I don't think I would be relying on Brazil as a news source. West Africa, it was already declining, and COVID made it even worse. There's now a 600,000 barrel a day extra supply loss because of COVID and the lack of maintenance, some of the issues with pipeline taps and whatnot in these countries. The supply is getting even worse, and probably why some of these West African cargoes are not selling. We need to keep in mind, and some people focus excessively on West African cargoes. It's a very small part of the world's sales, and there's other issues with West African sales from Angola and Nigeria. There's these force majeures all the time. Some of the oil is not of the highest quality. The storage capabilities within West Africa are not that great. It's not like Singapore or the US Gulf Coast where you can store a bunch of oil and then ship it out. It's basically like a just-in-time ship loading, which a lot of producers don't prefer, especially when you have force majeures going on all the time. So there's more to it than just, oh, we had like oil went unsold. Well, if 500,000 barrels a day of oil went, well, if 500,000 barrels of oil went unsold in a week, in a market that consumes 700 million barrels in a week, should we be focusing on that 500,000 barrel load that went unsold, or the 3 million barrels that went unsold? Probably not. It's making a mountain out of something that has consistently been an issue for the last 5 years. And it's been proven that West African cargoes going unsold is not reflective of the actual physical market out there. Because if it was, oil prices would have started dropping in 2021, but they didn't. Okay, where are we here? Okay, I think there's about, I don't know how many slides here are left, but I will try and wrap it up here in the next 45 minutes, 30 minutes. American supply, the best wells were drilled in 2016 and 2017, right here. 2016, this is number of production barrels per day in terms of time, or no, not in terms of time, but in terms of cumulative produced. So 2016 had the best wells. 2017, the wells started getting worse. 18 is worse, 19 is worse, 20 and 21 are going to be maybe better because of selective picking of the best oil wells, but still they're not going to match the 16 and 17 results. This is the shale production. Look how fast it declines. Is this really the production we want to be our growth wedge, to be our provider of the marginal barrel? Production that's down 60% in a year, 70% in a year? Not really. It's a treadmill. In December 2016, when shale jacked up all this production, they had to only make up for 1.3 million barrels of decline every year. So in December 2016, the new wells had to make up for 1.3 millions of declines plus the new growth. In 2018, it went to 2.7 million barrels a day of declines that they had to make up and then add production. So where are we today? We need to make up 2 or 2.5 million barrels a day of decline before shale can even think about adding any new production. So again, I say again, some of the Rystad forecasts, some of the forecasts that people are putting out are completely wrong. There's no way that any of that is going to happen with shale producing 7 million or the Permian producing 8 million. Totally out of the question. Permian supply, the wells are getting worse. Rate versus months on production. We see the declines are getting harder. The water production has gone up a lot. The water oil ratios have gone up a lot. So the wells are now producing 4 barrels of water for every barrel of oil, which means you got to dispose 20 million barrels of produced water every single day. More headwinds for this industry. Productivity down 18% since 2016. How have they masked that? They've been drilling longer wells, jamming more sand into them. And maybe people in the oil industry who aren't in the oil industry don't know this, but they jam like 15 million pounds, as in weight, lbs, pounds of sand into each well. So they keep jamming more and more. They keep making the laterals longer. We're not talking about 3-mile laterals and 4-mile laterals. It doesn't make a difference because productivity normalized by lateral length is down 18% already and declining. The Midland, late life declines. We see the declines are getting worse. Year 1, year 2. Look at the year 3 declines, 4, 5. These wells are declining way harder than what anyone projected in their mid to late life, which means the new production must make up for these declines before they can think about growing production on an aggregate basis. Yeah, shale is not looking good. When you look at the data, nothing here looks good at all. And you match it up with the supply chain issues, with the acreage issues, with the ban of federal permits, water disposal headwinds. Right here, shale's declines. The green is shale, Permian. Look at the decline rates are just phenomenal compared to Alaska, Gulf of Mexico. A lot more money will have to keep getting pumped in to keep production flat and growing. Permitting is still very low. The acreage is not very good. Conoco and Marathon have the best acreage in the Eagle Ford. The rest of the people, not very good. EOG talking about the triple premium inventory. It's not triple premium at all. In fact, it's third place by a long shot. So something to keep in mind between what management is telling you. Okay. Does a drought in the US not cause a shortage of water? Yeah. Yeah, a lot of fracs now are using produced recycled water because the freshwater issue is getting worse and worse in Texas, New Mexico, California, all over the place. Water disposal getting worse. With water disposal into deep reservoirs, you get earthquakes. The earthquakes are getting worse. If you look at this map and you overlay it with where the water disposal wells are, it will match up exactly. This is the Eagle Ford here, and this is the Permian. It's getting worse and worse. The earthquakes are getting more, and they're getting higher intensity earthquakes. Not a good look at all. Right here, cumulative number of earthquakes in the Permian. Very few earthquakes, some big ones, natural, and now it's just basically a straight line up because we have so many of them. Texas seismic activity by year, it's getting more and more. Does anyone care? Maybe, maybe not. What if there's a massive earthquake that shakes up the entire Midland, the town of Midland, and destroys a bunch of buildings? Will people care then? Hard to say, but it's all headwinds and it's getting worse. There's more earthquakes over 3.5 magnitude, over 3 magnitude, it's getting more. The intensities are getting higher. Again, ignore the problem until you can't, and it's staring you right in the face. Same thing, seismic events. This is not something that I take lightly. I think this is going to be the biggest headwind to shale, Permian shale. When there's a massive quake here, a 5+ or a 6+, and people get hurt, unfortunately, that's going to be the big wake-up call as to what's happening. The Bakken, talked about the Permian, let's talk about the Bakken. It's full. There's no place to drill left. The places that are left are the least productive and the second least productive. In the top acreage, there's nothing left. Why I'm bearish on the Bakken? Right here. This chart is all you need to know for why I'm bearish on the Bakken. 81% declines in 11 months on these new refract wells. 81% decline in 11 months. So you need to drill the same quality of well like every 2 months to keep your production flat. Doesn't make any sense as a company, especially as the acreage keeps getting worse and worse and worse. Gas to oil ratios in the Bakken. Somebody asked about this in the chat. The gas to oil ratio is rising every year as the reservoir pressure depletes. The BOEs in the Bakken have stayed roughly the same, but now 30% of those BOEs are gas compared to 15% 10 years ago. So how much oil production has been actually lost, but the BOEs, the barrels of oil equivalent, has stayed the same. Yeah, I'll just say this here, for anyone that's on the Twitter call that wants to join for the visuals, the link is on the White Tundra website. Scroll to the bottom under events, and the Zoom link is there. It will also be recorded and posted shortly after. DJ Basin in the US, just because the reservoir extent in blue is so big, doesn't mean it's all economic. Only certain parts of it is. So when I shared the graph earlier about the USGS of the Permian, not all of it is economic again. So how many years of reserves do they really have? Is it 40? No. Is it 20? Even 20, I think, is probably overstated. It's probably 10, 12 years left at this point, if not lower than that. And somebody asked about this too in the chat. As the laterals are getting longer, the barrels of oil recovered per lateral foot is getting worse and worse. And these are just 2-mile wells. Chevron is talking about drilling 3-mile wells. Well, extrapolate the same graph. Per lateral foot, they're recovering way less oil. So they're leaving way more oil in the ground by drilling these longer and longer laterals. So, okay, if they're drilling longer laterals, they're leaving more oil in the ground. How much reserve do they usually have? Or how much reserve do they really have? Can we reduce that by another 10%? Yeah. High decline rates. What did companies do in 2020 and 2021? They jammed up the lateral lengths. They jacked up the proppant sand injection in these wells. They had massive fracs so that they can have huge production, claim to have really good acreage, and sell to a bigger producer, cash out, and move on. What actually happened, we didn't have too much consolidation in 2021. And a lot of these wells now are having massive decline rates 5 months or 6 months into the cycle. The blue wells, or the red ones, are the 2021. You see how the rates are higher, and then the rates become lower than they've ever been. Another headwind for all production. Why drill longer if it produces less? So the longer laterals actually produce more, but on a per foot basis, they produce less. So companies want longer wells because they can produce more oil out of one well. They only need one drilling rig as opposed to 2 or 3 if they drill shorter wells, but it's costing them in the long run on the overall recovery of the reservoir is way worse. Like if we look at this example, 2 years in, the recovery is like more than 20% down, like 30% less, which is pretty big when you take this to 5 million barrels a day of Permian production. I don't cover the Canadian reservoirs really as a supply because to me that's obvious. The Canadian reservoirs are the only ones that can really cover this shortfall. But political will and capital discipline seems like that's not going to be the case. But I think I will. This is a Canadian oil well here, a fracked well. Guyana, this was mentioned again. So Guyana is adding barrels, it's growing, yes. In the next 6 years, Guyana is going to get to up to 1 million barrels a day, roughly. So how much is that? In 6 years, they get to 1 million barrels a day. So they're adding roughly 150,000 barrels a year. If demand goes up by 2-3 million barrels and conventional oil is declining at 2.4 million barrels, if we lose Russian oil of 1 million barrels this year, adding 150,000 a year, does it move the needle? It is nothing. We need like 20 Guyanas increasing at 150,000 barrels a day to really move the needle. And where are companies starting to invest now? In high taxation regimes, because the easy oil is gone in the low taxation areas. They're now starting to invest in Suriname, Brazil, Guyana, Mozambique with the LNG projects. They're investing in Norway with the government take being so high. Saudi, Kuwait, etc. This is where I prefer to be, right here. The lowest royalties, the lowest taxes, the most free market, with the longest reserves. Just my opinion, and why I keep talking about Canadian producers, along with the US as well. Iran. What's going on in Iran? Can they really increase production a lot? Okay. They're producing 2.5 right now. Internal consumption is 1.6 to 2. So let's take 1.8. So they're exporting roughly 700,000 million barrels. Some of that is from inventory because they're obviously not producing it. They are sending it from inventory. So what can Iran really do? Well, they can increase production by roughly 1.2 million barrels in the next. Look how long it took them to increase production after the sanctions. It took them over a year, 2 years. It's not going to be sudden that the sanctions come off and there's 2 million barrels a day on the market. Not going to happen. I can tell you that, and I'll say that here on the recording. It's going to be a slow, gradual increase, and they have maybe 1.2 million barrels to add. Does it move the needle? Not really. It helps the supply shortfall. It doesn't put us into an oversupplied situation. Is the Iran sanction waiver going to happen? Nothing has really proven that way. So we can't take it for granted anyway. Is Iran's internal consumption going to go up if the sanctions come off? Yes. The internal consumption could go up by 200,000, 300,000, 400,000 barrels a day. So how much can they really export? Maybe 750K barrels over the next 2 years. Is that really moving the needle? No. And it's one of the big factors that's still left. Some might even think it's priced into the market already, Iran coming online. How much are they producing, Iran? This is the flare index in the country. Seems like they've kind of plateaued at this production level here. They seem to be having trouble with increasing production back to their rates that they did back here. They definitely seem to be having an issue. Look at their tanker fleet. 84% of the tankers are over 15 years old. These are all the illegal tankers, by the way. Yeah, this comment right here, sanctions have taken a serious toll. Yeah, you can't just not pay attention to repairs and maintenance and CapEx and expect to increase production back to these levels. I don't even think Iran has the production to increase that 750 that I'm talking about. That's just in the best case scenario. Our Iranian supply to China, it's getting harder and harder for them. They're using more ship-to-ship transfers. It's costing them more money to send this oil to China. It's not just load in Iran, go to China. They now go to Singapore, transfer it to smaller ships. The ships then go to China. It's getting more expensive. It's getting longer. It's getting harder and harder to do these things, which is obviously weighing down on a country that only has so many tankers. You can't just procure hundreds of illegal tankers that should have been scrapped and put them into service. So don't expect Iranian oil to suddenly come in and make a huge impact. It's not going to happen. Over time, yes, but still not enough to really move the needle. This was Iranian floating storage 3 months ago. This is today. They're actually pulling from the floating storage, as was mentioned earlier, to feed their exports and internal consumption, which means they might be having trouble with their internal oil production. Something to think about. Venezuela, currently producing 700,000 roughly, 730 right here. What did they produce at in the last decade? In the last 2 decades, the max was about 2.5. That leaves us 1.8 million of extra Venezuelan oil that could potentially come on the market. Okay. Out of that 1.8, 600,000 is going to go to internal consumption. As the country recovers, as money comes in, we're going to have 600,000 go back to its old internal consumption, maybe even more. So let's take 600. That leaves us with 1.2 left to export. It's going to take Venezuela 3, 5, 7, 10 years to get back to these levels. They've had underinvestment for 7, 10 years now. Their assets are in total disregard. Cannibalized pipes, refineries that can't process crude. They send out contaminated crude that keeps getting returned. It's not going to happen anytime soon. So 1.2 million barrels a day over the next 5 years. That's 240,000 barrels per year additional to the market. Does it move the needle? It doesn't do anything. When the conventional declines are 2.4 to 3 million barrels a day every year, what does adding 240 really do? It's less than 10%. So don't rely on Venezuela either. You can't throw money at this problem and solve it. It's going to take time. It's going to take sustained higher pricing. It's going to take a appreciation of what the oil industry does. It's going to take a lot of people having to eat crow over their aggressive ESG goals. It's going to take politics out. You have to take politics out of the equation, which is seeming hard to do. So don't expect this to happen anytime soon. It's going to take time. Let's talk about the other countries that are conventional. Colombia. Colombia's oil production is going down in purple. The drugs, cocaine production is going up. I won't make any comment on that. We have right here, Colombia again, oil production, terminal decline. Azerbaijan, terminal decline. The Indonesia, terminal decline. India, Egypt. This is 4 million barrels a day of conventional production, 3.2 in terminal decline. Gabon, a producer in OPEC, I believe, decline. Equatorial Guinea, no sign of recovery at all. Nigeria, totally declining. Algeria, down. Recovered since COVID, but the overall trend is still down. Angola, they couldn't even recover their COVID losses. The Congo had some projects come online, declining. Algeria exports, declining. So we just talked about 40, 50 million barrels a day of conventional production here between Russia, Saudi, the Middle East, Kuwait, all these countries, Nigeria, Angola, they all seem to be in decline. The data is agreeing with what the trend should show. Why do I mention Algeria exports? Because as the production declines in these countries, their internal consumption is going up. So the actual exports that these countries are putting out are being impacted by a double whammy. Not only is the production going down, but the internal demand is going up. And I can tell you for a fact, the Algerian demand forecast or the Colombia demand forecast is all probably way too conservative. If the demand in these countries, kind of like Mexico, starts increasing and the production starts decreasing, these countries might not be exporting oil anymore. They might become net importers, like Mexico is going to be here shortly. Worldwide supply, there's the unplanned oil disruptions, there's really not much left to take from. Most of it is Iran. There's no easy levers to pull here to bring production online. What are the banks saying? Morgan Stanley just raised their forecast to 130. Michael Tran with RBC, structural strong cycle. Bank of America 120, Goldman Sachs 135. Say whatever you want about these banks talk in their book. They've been right. They've been right so far, and they're probably going to continue to be right here going forward. There's a question here on what extent are these declines due to the low prices and ESG standards? It plays a factor, but the oil industry is one where you can't just throw money at it and solve the problem either. There's geology, there's other politics in all these countries, and conventional oil just declines. You can't throw enough money at it to keep it at its peak. So just money is not going to solve the problem, which gives me more conviction in my trade and my investments going forward, is that it doesn't matter if they throw money at it, they cancel ESG, it's still going to be 3, 5, 7 years of sustained high oil pricing before we see any change. The party's just getting started. We're very early in this cycle, and you see how far the gains go. I should update this chart because I'm sure it's changed. It's only till September here. But either way, there's a long ways to go. The free cash flow is looking amazing. After many years of losing money and lower free cash flow, they're finally making money. People have know that I talk about this a lot, that the stocks are trading at much lower multiples than they did in the past. They're implying a $73 WTI price when the WTI price is trading at a strip of 101, 100 plus. Big valuation gap there. Energy is punching way below its earnings potential. And this has probably changed even more since January. There's a big gap in the upside on these equities. So if oil prices drop $20, it really doesn't change my thesis, because there's such a large gap between the valuations that my downside, I believe, is very low. Again, not investment advice, just my opinion. But I see no reason oil price is going to drop $20 to begin with. Look at the performance difference last year between oil and gas ETF and the clean energy ETF, it's about 100% difference. This year so far, 60% difference. The same to the oil and gas ETF versus the clean energy ETF, there's a further 60% difference in performance. Clean energy is just getting whacked and money is flowing back into oil. Oil consumption, cost of GDP. So we're talking about now the recession indicators and all this. Look at how far consumption falls. When oil consumption becomes, let's say, 5% of GDP, we see consumption fall. It doesn't just all fall in 1 month. Like, you're not going to see demand destruction of 2 million barrels a day in a month. That's not how it works. You slowly see a sustained demand destruction, and then it rebounds as the price gets lower. We're currently well below the 5% of GDP number, and the demand destruction is not going to be that much, especially when we have subsidies, we have lower taxes, etc. Energy as a total of personal consumption expenditures is the lowest it's ever been. You compare it to 2010 to 14, we have roughly $30, $40 a barrel still to go before we get here. Don't compare this to 2008. This is not 2008. That's very lazy analysis. Just saying, oh, it's just going to be like 2008. We're going to have this spike and this drop and blah, blah, blah. People aren't putting in the work. So it's not worth listening to people who just throw out random correlations with nothing to back it up. US gasoline price as a share of hourly earnings, it's still well below where it was in 2010 to 2014. And we saw no major demand destruction at that time. So again, people are making way more money and have way more discretionary income for gasoline to be a big impact right now. Share of income spent on food, disposable income, it's been going down for a long, long time. So despite the higher food pricing, it's not like it's suddenly totally collapsing society. We've lived with 14% of our incomes going to disposable income going to food in the past. Even recently, it was as high as 10%. So yeah, some of the sensationalist, exaggerated news headlines and claims out there that are not backed up by data, I just laugh at them because there's data freely available that totally destroys their argument, but they keep saying the same thing and keep pandering as if society is just going to collapse tomorrow, not appreciating how stable society has become or is, despite all the stuff going on in the world. I am very proud of working in the oil industry and investing in the oil industry and into the future, pushing for more oil and energy usage for the people. Energy and oil specifically have brought a lot of people out of poverty. A lot of people out of poverty. Look at the divergence here between when oil really became the primary energy source and how many people are not living in extreme poverty. So for all the talk about like you do pollution and you kill the environment and blah, 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 there's a fine balance there. We need energy to live. There's no way 7 billion people could live on this earth without oil or natural gas or coal or whatever else. So I think it's time that people really realized how much energy does for us, and oil and natural gas and any type of energy, doesn't matter, how much it contributes to our quality of life. If the entire internet went away tomorrow, society would have huge impacts, but it would continue on. But if we stopped having oil and energy, like at the snap of our fingers today, society would be gone in less than a week. The entire world would be absolute chaos. So money is going to come back to the real assets. I believe this. And I'm kind of diverging here, but so I'll leave it there. Renewables, we're going to get cheaper forever. No longer the case, because renewable prices depend a lot on oil prices and metal prices, which are going up. Gasoline has 100 times the energy density of a lithium-ion battery. Batteries will never be able to replace the convenience and the energy density of fossil fuels. That's a fact. That's science. What programs would encourage people to buy electric vehicles? Tax reductions, free stuff, incentives, free stuff, other free stuff, like more free stuff. That's literally why people are buying EVs. They don't care about the convenience or the saving the environment or whatever else. They buy them because they get deductions. They don't pay road taxes yet. They get free parking in some places. They get free charging in some places. It's all going to change. And I believe the EV sales are going to follow this trend right here, where you have this massive uptake with subsidies, grants, etc. And then as those are phased out, people just don't really care about electric vehicles that much. A completely different graph, but I found the trend pretty interesting of how I think it's going to go. It might go more than 12%. It might go to 50%, but there's going to be a maximize there. At which point you can't replace everything with electric batteries, right? Like look at airplanes, look at big tractors and such. You can't just replace them. Okay. Yeah. So the reason why this is so bullish, and people have mentioned this to me a lot, is because I take any bearish argument that people throw at me, I spend as much time on it as I can, pull up exact data, and try to make an insight on it as to what the impact is, and then put it in the presentation. This is not meant to be like only a bullish scenario. If some of the data changes to say otherwise, I will be the first one to share it here. But so far, I don't really see anything major that's impacting this. 7 years out, how are you thinking about terminal valuations? It's really hard to say 7 years out what's going to happen, but I think the valuations will reflect the 8 times free cash flow that I've been talking about within the next 12 to 24 months. I do think we get back there. All this talk about stopping selling electric vehicles or stopping selling ICE vehicles, internal combustion engines, doesn't really matter. You could have the most optimistic electric vehicle sale forecast. There's still going to be light duty conventional gasoline and diesel vehicles out there because they're already out there. People aren't just going to trash their gasoline vehicle once they buy an EV. They're still going to continue running forever. Oil is not dead by any means. And it's too bad people have been brainwashed into thinking that we can go off oil in 3 years or 5 years. Lithium carbonate prices, which go into EV batteries. How many price increases has Tesla had in the last year? A lot. When the base prices go up, when the price of energy goes up, EV prices go up. It's a basic fact of life. Battery supply and demand. I'm not going to go into this. We don't have the minerals to build the EVs that they say we do. Copper, lithium, cobalt, same issue. We don't have the minerals. Even with the under construction plants put into these scenarios. How much minerals does renewables use? Here's natural gas, here's coal, here's solar, and here's wind. It uses a lot of mining and minerals. Here's the electric vehicle versus the conventional vehicle. That's how much batteries, minerals we need. We don't have them, and B, to extract them is extremely ESG non-friendly, a lot of pollution, and a lot of it is in countries with poor social and governance standards. So European power generation last year, they actually ended up using 18% more coal in 2021. When people want energy, they will find energy. They will use coal, they will use whatever. You can't force countries to go off coal and die rather than using cheap sources of energy. Annual rooftop solar installations, not looking that great. Like, we don't really see a huge increase. It's like a linear pattern at this point. Into 2025, nothing crazy is going on. And the United States actually, yellow, is declining. So totally against what people tell you is going to happen. For the chat here. What are your thoughts on a recession? So I'll talk about this here in a sec. Okay, wind output, solar output combined. Is this what you want to rely on as your source of power? Something that's so volatile, you can't even tell how it's going to go, or if you're going to have access to it. Again, wind and solar percentage of global energy demand, you can jam out as much solar panels and wind as you want. You're not going to replace oil in 5 years or 10 years or even 50 years. It doesn't matter. Hydrogen, this was interesting because I got an email about hydrogen being the next thing. In a high case scenario of hydrogen electrolyzer capacity, it makes up 0.2% of global consumption by 2030. People should not be talking about hydrogen as some sort of energy source. It's just a waste of time. 0.2% in 8 years in a high investment scenario doesn't make any sense. Electricity prices in California rose 7 times more than the rest of the US. How long are the people going to put up with it? With ESG and renewables and cost of transmission, something that doesn't make economic sense, pumping out subsidies. I don't think very long. 7x is a pretty big divergence that's happened. Global oil demand, without decarbonization, with decarbonization. That's what's happening here. It's not that with decarbonization, oil demand goes to 0. It's that it doesn't go to 110, but it goes to 105 instead. That's basically the entire point of my seminar here, is that renewables are, yeah, they're going to be a part of it, but they're not going to kill oil. They're going to take away some oil demand. And we adjust to the supply demand accordingly. Eric Nuttall just said yesterday there's not going to be any windfall tax because the governments realize what a cash cow energy is right here. Energy merchandise trade balance is the only thing keeping the Canadian economy afloat. The rest has been declining and is all fake paper money, really. It's energy that's keeping the trade balances afloat. We need investment in everything, not just fossil fuels, renewables, transmission, energy efficiency, everything. We need investment in everything. We are in an energy crisis, not an oil crisis, all sorts of energy. I just choose to invest in oil because the valuations are way better and I know oil way better. Know the companies way better. Manipulating the oil markets, okay? People say, well, silver is manipulated, gold is manipulated. The oil market is 4 to 5 times bigger, the real oil market, than every metal in the world combined. So can you screw around with paper contracts and mess with the price of oil? Yeah, not for very long. You're not going to have very much luck doing it for too long. So keep that in mind. Yeah, the paper market controls what's happening and positioning and all this, but when the physical oil barrel is required, people will pay what it takes to get the physical delivery. And the one thing with oil that's different than these metals, once you use oil, it's gone. You cannot get it back. Compared to gold, you can reuse gold, you can reuse iron, you can recycle copper, et cetera, et cetera. Oil literally goes into thin air, and you can't invent oil. This is not a video game where you just inventing oil and bringing oil. Okay. So there's a pretty interesting comment here. So the reason I talk about the stock valuations a lot is because in the past, during a recession, the stock valuations were already 6 or 8 or 10 times cash flow. So the downside risk in a recession or a pricing drawdown was significant. Today, you can buy stocks trading at 3 times free cash flow or 4 times cash flow. So if the price of oil falls 20%, these companies have way less debt, and they're already trading at basically no worth given to their reserves or production value 3 or 4 years down the road. To me, the downside risk is very low from that standpoint, despite their 10x from the COVID levels, which is a little bit different scenario than a recession. Misleading graphs. I keep seeing this over and over and over, so I need to mention this. Year-over-year graphs are completely fake. They're made to prove a point and push a certain mandate. This graph was shared saying that Chinese cement production is going down, meaning that the Chinese economy is collapsing. Look at the same graph as a non-year-over-year graph. It looks pretty good to me. I don't see any issues with Chinese cement production going on. They picked the highest number here and like right here, and they compared it with this number and claimed there's a year-over-year decline. Be careful with the graphs out there and people pushing certain narratives, especially with the year-over-year comparisons. And I'm seeing more of these in oil now, and I'm seeing more of these used to show that a recession is coming. No. Show me the graph like this on a time axis, not year over year, but raw. And you'll see a lot of these graphs stop making sense as being a panic indicator. Quickly on COVID, I don't want to spend time on this, but basically the Omicron has shown to be the lowest impact virus so far. Looks like China is the last country that's really grappling with this. Things are looking good. I don't think there's any other problem going to happen with a COVID shutdown here, and the people are not willing to do it anyway now. Open interest in the futures contracts is at the lowest in 7 years. So it's not like we're all crowded into an oil trade pushing higher pricing either. If the paper market starts to agree with the physical market even more, it's in fact going to push price higher, not lower. Again, keep this in mind. People will talk about the paper market is doing this and doing that. Well, the paper market is already pretty low on the bullishness on oil. So if it has to start agreeing with the physical market, it's going to push prices higher, not lower, contrary to what a lot of people claim. How many slides do I have? So on the recession part of it, I'm not going to claim to be a macro person on the overall economy. I just look at graphs and I make an insight onto them. Household debt to GDP is much lower than it was in 2008, and in fact declining. Household debt payments as a percent of disposable income are the lowest it's ever been, and much different than 2008 when they were starting to go up. They're now flatlined or going down. Household net worth, this is not inflation adjusted, so keep that in mind, but the net worth is going up and rising. Just before a recession, you'll see it start to draw down, which hasn't happened. federal government tax receipts are through the roof. The government gets taxed when people are working, when people are making money, when businesses are making money. Things look good. We don't see this flatlining or reduction yet. Federal tax receipts, thanks to Bill for this, they're up 19% over 2020 and 2021. Compare them to 2019 and 18. Everything is up substantially. Corporation income taxes, employment taxes, totals, substantially up. People are making a lot of money, which is going to be used to spend on goods, on services, on whatever. So yeah, so the household net worth, yeah, there's some sort of correlation to real estate prices and Tesla shares. Okay, what explains this then? How come the taxes are through the roof? People are working, people are making a lot of money. The US population on unemployment is back to pre-COVID levels. The new weekly unemployment claims are pretty much at the lowest levels and declining. I don't know what these are in a recession, so I'm not going to claim here to make any broad market claims that there's no recession or there's no this or no that. I just think the demand destruction from a recession is being way overstated, as if half the US population is going to go bankrupt, which doesn't seem to be the case based on what I'm seeing. Where are we? Inflation adjusted crude oil, pretty low, not looking like a big problem yet. And the final slide. This is all that really needs to be said. Despite all the people saying that energy stocks are going to collapse with the broad market drawdown, saying that oil is dead, saying whatever, energy is up 37% year to date. Tech is down 19%. The NASDAQ is down 20-25%. The energy sector continues to rally on. And I believe this divergence is going to get bigger and bigger as people rotate into real assets, people rotate into cash flowing, free cash flow generating companies from all these 20 times sales multiples and whatnot. People are going to be under a lot of pressure. Portfolio managers who have totally lost a lot of money are going to be looking for where the money is. I think the inflows are going to be pretty good here, May, June, July, August, along with the supply demand numbers, obviously. I see no reason to sell anything. I have switched my positions, yes, on certain names, but as far as my overall portfolio, there's no reason to panic on a China news. I haven't even mentioned anything about geopolitical risk of Houthi attacks on the Saudi Arabian infrastructure, or anything like that, which is getting more and more of an issue. Yeah, so I think if we do get a recession, I don't think the WTI is going to move at all. There's too much demand for oil. There's not enough supply. The inventories are so low, and I think the recession is not going to affect people that much. To be honest with you, like the consumer, I don't think is going to be very affected in terms of oil consumption. They might stop, they might cancel their Netflix, they might have to move to a smaller apartment or whatever, not eat out as much. But I think the energy consumption is not going to change. After 2 years of being locked down, you're going to tell your kid that he can't go camping this year or can't be joining basketball tournaments or whatever this year? Really? Back to human nature. People will pay for energy. People will pay for energy. And that's it. Thank you to everyone who joined. I think we're 3 or 4 hours in now. That's pretty good actually compared to the last one. So I'll leave the floor open to a few questions. I don't want to drag it on too long. Sorry, I don't want to drag it on too long because I know the people want to say some comments on Twitter Spaces, looks like. So maybe I'll leave 10-15 minutes for questions if there's any, and then wrap it up. And again, appreciate everyone's time. and joining in. I would love to make this more of a participation, back and forth kind of thing, but it's just so hard because we would be here for like 48 hours discussing things. So I'd rather have the recording and then leave the Twitter spaces for the discussions. The recording of this again will be on the website here in a couple hours. And then next week, May 7th, we have Tourmaline, Tamarack Valley company valuations, along with a Petroninja Wells update on Spartan Delta, Surge, Whitecap, ARC, some of the other companies I'm tracking. So I look forward to sharing that. And following that, launching some other White Tundra suites here, updating the price targets based on the Q1 results. I still want to do that. And yeah, just appreciate everyone's support. It's awesome to have more and more people joining and sharing the links and learning about energy and oil. I'm actually amazed how many people were interested in learning about water flooding and CO2 injection and whatnot. So yeah. Okay, so there's a few questions here. So if you had new capital, no positions, and couldn't buy options, what are 3 of your favorite picks? Ooh. I don't really know if I want to answer this question, but basically the recent names I've added kind of portray what I'm thinking anyway. I've talked about Whitecap as benefiting from the net zero fund inflows. So that would definitely be in there. I think Meg Energy with its 60-year reserves is going to get more and more people watching it. And I would probably pick a refining play. I think, pick your favorite refiner that's exposed to the upstream as well. And those companies are just printing cash at these crack spreads. So yeah. I can't talk about Suncor, unfortunately. I've got a close family member working there. So I would love to answer your question, but I can't. Sorry about that. Your opinion on Whitecap results? I think Whitecap results were amazing. Like 1.4 billion of discretionary after a 3.5% dividend. That's pretty good. I think that's pretty good. I believe they go in and make another big share block purchase before the May 20th deadline, I believe. And I think they make another couple acquisitions. I would think they want to reach 200,000 BOEs a day by next year. So I do think they make some more acquisitions. And I think the net zero inflows, that's the main thing. This company has been sitting at $9, $10 for a while. We need the new inflows coming in to really move it, or the buybacks, which they seem to like the block buybacks, not the sustained buybacks. But yeah, I bought a lot of Whitecap option contracts. It's getting pretty ridiculous how many I have now. So I'm right there with you. Can you talk to your top holdings currently? I'll be updating the May list here next week, and that will show the latest. I did share that I bought pretty big into Tamarack Valley. Made 3 different buys actually, and yeah, there's nothing else that's really changed. But I'll update the weightings here in early May. Why is your fund closed? I'd rather teach people how to fish than to fish for them or give them fish. So I love providing information and sharing my passion, sharing my data, sharing what I'm seeing. And I think I just rather prefer people make their own decisions and have their own conviction, because the last thing I need is people calling me as to why the fund is down or why it dropped 3% a certain day, because I look at more of the macro and invest accordingly, not the day-to-day movements. And I just prefer to share the data and people can have their own insight or interpretation and invest accordingly. I just saw that Einhorn's portfolio did well. Yep, Greenlight Capital. Yeah, the only people that did well in Q1 are the metals and the commodities, potash, oil. really nothing else has done well, not 10% anyway. Dr. Al-Haji says the impact due to recession is 400,000 barrels a day. Yeah. If that's the case, why are people even talking about a recession and the impact it has on oil demand? And the thesis we have here, the supply demand gap is way more than 400,000. It's by this summer, the supply demand gap worldwide could be upwards of 5 million barrels a day. So the world's greatest recession that would destroy society is not going to have a 5 million barrel a day impact worldwide. So why even talk about it? How much can Russia export to China and India? Yeah, so tanker fleets are a constraint. Indian refineries can't run too much Urals grade crude. So keep that in mind. Same with Chinese refineries. How much can Russia export more? Not enough. So not enough to counter their entire production. So we're going to see a 2 million barrel a day loss or whatever, either way, no matter how much China and India take, because they literally can't process it. And Russia doesn't seem to want to export products, or they can't. So you've got a big issue here. Opinion on Enerplus after the Bakken update. I didn't really listen to the Bakken update, so I don't have a good answer for you. I wasn't focused in on it. They seem to claim that they have a special part of the Bakken, which is fine. I just don't care about the Bakken in general to really look into it. Unfortunately, that's all I can tell you. There's other things to focus on right now, I think, that are more interesting than the Bakken. Yeah, that's what I think. Even if new investment is ramped up, I don't think there's going to be an oil down cycle. It's going to be a structural cycle here. Supply, demand, inventories, they're all pointing bullish, even in the face of a recession and throwing trillions of dollars into energy supply. I can't find a good thesis where these stocks get absolutely crushed, unless a big asteroid hits the world and kills half the people. Yeah, okay, but you can't invest based on random chances of stuff happening. Yeah, I think so. I think the energy stocks stay stronger for longer. There's going to come a time where the risk reward for each person's individual risk tolerance may not be worth it, but I think the stocks do stay stronger, especially if they benefit from higher multiples. Definitely. Who in Q1 has disappointed you? No one really. They've all been good results. Cenovus, Whitecap, Advantage, and Baytex, I think, are the 4 major ones that are out. They've all been great, like really great. So there's been no disappointments. Not all of them fit the way I want my investments to go about the shareholder return policy, but I think in general, the earnings have all been good so far, and I look forward to MEG and ARC Resources. Yeah, and some of the other ones here coming up, Vermilion. What are the top 3 refiners? I honestly don't know. I'm talking about Cenovus and Suncor in Canada would be the 2 that I would look at. I don't like the pure play refiners. I like the integrated companies. You're double dipping, so yeah. Expecting anything that will move the needle from Vermilion earnings. I think Vermilion will announce a share buyback potentially. They don't need to. I don't even think they should be buying back shares, but I think that's what they're going to do. I don't think the dividend goes up. They want to use their free cash flow to buy really good stuff that's going to trade at very good pricing 6 to 12 months from today, and then in the meantime they'll have some sort of share buyback program, but they only have 160 million shares out, so you don't want to buy back too many shares and cause there to be like a consolidation issue and a poor market liquidity. Yeah, thank you. Beth, you had sent me a direct message about something, and I missed it. If you wouldn't mind DMing me on Twitter the same message, I would appreciate it. What was it that made you pull the trigger on TVE? The fact that it was dropping this week compared to the rest of the market, I think would be the main thing. I like the new Clearwater acquisition, and the new wells are coming on really strong, even stronger than I figured earlier. So that changed the needle. I think the market doesn't understand the put options. I myself was fooled by these put options earlier. So I would say the results come in very strong. And I think their debt target is actually pretty reasonable. It's not super aggressive where they want to lower the debt to zero. So I like that fact. The fact that they put out a dividend increase already is pretty sweet. So yeah, just overall, I think that's good. And I've been following their Charlie Lake wells. They have the top 4 Charlie Lake wells out of the top 10, I believe, of the newest wells out there. So I like companies with production outperformance. If you'll notice, a lot of my portfolio is built around that. Surge, Meg, Arc Resources, Spartan Delta, Tamarack. These are all companies that are beating production results. If you look at the top 10 lists of companies out there with the top wells, these are the companies on there, Whitecap. So I really like that fact. Baytex earnings, Baytex was pretty good. They've got the best wells out there, and they've got 300 of them, 300 locations already. So if they can keep doing this, I think their Clearwater could be a 50,000 barrel a day producer, 2 to 3 years from today. Why not? I would say that they should have sold some of their assets. They got too much going on right now between the Clearwater and the Eagle Ford, the heavy oil, the Duvernay. It's just too much going on. They need to either get rid of the East Duvernay or get rid of Eagle Ford, sell it to Marathon, and move on, because it seems like they're struggling with managing all these, and then the hedging situation is also impacting their earnings. But people were front running these earnings. Baytex was up 15% from Monday to Thursday last week. So for it to go down 8% is not crazy on Friday. Yeah, it's great to see these Canadian stocks on these Fidelity reports and whatnot. I saw one from, I think it was Goldman Sachs, that had a bunch of them on there. So thoughts on Baytex's lack of clear guidance. It's affecting the stock for sure. Cenovus set a high bar. Yeah, for the clarity, yeah, they set a high bar on the clarification. I don't like the actual plan itself, but how clear it is definitely is a high bar. What are your thoughts on Vermilion? I think I've made it pretty clear my thoughts on Vermilion. It still remains most mispriced equity out there. Check out my April 2nd seminar if you want more of my thoughts. But yeah, I'm not selling my Vermilion options by any means. They're going to do good, I think, for me going into December. Do you expect Meg to be a banger? Yeah, Meg is going to be good. Meg's production in March was, I think, 102 or 103,000 barrels a day. So they're not taking their foot off the gas pedal. And every 1,000 barrels of unhedged production at $90 WCS, yeah, looks pretty good. What is it here? Surge Q1 results. Nothing's going to be anything outstanding in the Q1 results. I think the Q2 results will have the dividend announcement and a possible share buyback. Plus, Surge just going unhedged on June 30th. I mean, an extra $150 million of free cash flow swap in one day. I'm already loaded up, so I see no reason to sell Surge. I think the inflection point changes a lot of things come June 30th and July 1st. So yeah, I look forward to that. What is the best Canadian oil ETF? I honestly don't know. XLE, is that Canadian? I don't really follow ETFs. Maybe Eric Nuttall's fund. If US investors can buy that, would be good. Isn't that loss from Russia already priced in? I don't think so. No, I don't believe so. I think people are trading off the headlines that Russian crude export hasn't been affected, because we're still at the same price where we were pre invasion. If you just extrapolate that same trend line, I don't think it's being priced in at all, which is shocking. But I think the Chinese lockdowns have muddied up the situation where the Russian loss isn't being properly understood right now. I think everyone was expecting Baytex to announce a dividend. No, there's no way Baytex should have been announcing a dividend with their debt where it is. Yeah, I don't know how people can expect that. That's a little too aggressive. Vermilion is going to be great. ARC Resources, I think the earnings are going to be good, but I'm not expecting anything. I'm going to go into it with no expectations. If they announce a dividend increase or a share buyback increase or some, I'll take it. But that management is so conservative. I realized, like, oh, it's just amazing. I've heard stories, I've talked to people, and yeah, that board and management is so conservative. They think the earth is going to fall upon themselves every day. So I wouldn't expect anything super aggressive from them. Let the cash flow do the talking and keep the share buyback going strong. Yeah, Vermilion already released Q1. That's right. Yeah, I love Vermilion. Like I said, and people talk about this. If Vermilion 3x's from here until December, which if anyone knows me, I think that's possible, my option goes up 40x. So again, anyone wondering why I don't have Vermilion in my portfolio, that's why. I have so much leverage built into these options I bought in December. There's no point buying equity at this point. I have a huge exposure. Birchcliff, a takeout candidate. Yeah, everything's going to be gone. In a couple of years, there'll be no more Birchcliff, Crew, Advantage. All these small gas players are all going to be gone. Once Canadian LNG becomes a global market. How does one track Westcan's drilling progress? There's no real way, unfortunately. It's a public company, so there's only so much that can be disclosed. Yeah, we're just gonna have to keep tracking Petro Ninja results and look for news releases. I think Westcan's drill, they should be posting results of the drill right away. Like, I don't expect us to have to wait to get Petro Ninja data to figure out what it's making. I think there's going to be news releases that's going to actually share how the drill is going or when it's starting. Thoughts on Cenovus using 100% FCF once debt at 4 billion? Be careful with what Cenovus is telling you. They're not saying their debt is going to be at 4 billion. What they tell you is that their debt is going to be somewhere between 8 to 10 billion, and they're going to keep $4 to $6 billion in cash. That's their definition of net debt. So I wouldn't get it confused with that they only have $4 billion of debt. Their debt is actually going to be higher, and they're going to keep a bunch of cash on the books. Very conservative plan, very conservative management team, and the reason why I sold my Cenovus. It's just too conservative. You're making 0% on $4 to $6 billion of cash sitting there. Really? You can't make more than 3 to 5% on that cash. Doesn't give me much confidence in them thinking they can actually generate cash. I3, I think the dividend goes up. And acquisitions, there's a bunch of acquisitions out there that I think i3 can make right now at a pretty decent price, like 2 times cash flow using a 90 strip or an 80 strip. Yeah, go for it. Whoever on i3 is listening, go for it. get a lot of nice, good stuff that can be optimized. Do you see institutions entering slowly? I think so, but not really. It's going to take a bunch of good earnings, maybe 3 quarters, 2 quarters, high dividends, high share buybacks to see that. Yeah, the recording will be on the website. Joseph Schachter says Surge could go to $40 in 5 years. Yeah, I wouldn't use him as a guy to trust, really. So yeah, I'm sure it could, and I think that's probably the same way that I think. But he's been bearish the whole time for the last 18 months, and for him to now come and take credit for being right, yeah, that's totally against principle. Yeah, I don't agree with people like that. Yeah, I truly believe Russia isn't priced in. I mean, a 5 million barrel a day supply demand deficit this summer, I don't think that's priced in. There's no way, because that would mean oil prices would be $200 plus. Yeah, there's no way that that's priced in right now. The futures are way up because the SPR was released, and it changes the supply demand right now compared to 18 months from today. Again, in my opinion. Anything new on Razor? I don't really have any update, no. It's going to be a slow gain, as I said. Please check out the April 16th presentation as to what my thoughts are longer term. Yeah, nothing really else much to add on Surge Energy. Yeah, it's become 70% of my personal portfolio now. That's right, yeah. But yeah, I'm not selling a single share. The well results are coming in very strong, and the unhedged cash flow, let alone June 30th. Check out the unhedged cash flow in 2023, or not unhedged, but what the cash flow changes to once the hedges drop off on January 1st, 2023. And then check out the free cash flow yield that is. And there's a reason it's 70% of my personal portfolio. I don't have any thoughts much on Journey, to be honest with you. I don't really follow the company. I could add their well results into my latest Petro Ninja on May 7th if you would like, but I really don't follow that company. New Vista and Crescent Point, great. I like other names. I like Spartan Delta instead of New Vista, and I like Whitecap instead of Crescent Point. I just think both of them are going to be set up better and trade at better multiples right now. Do you think Surge will hedge again in advance of January? No, I don't think so. They're going to hedge roughly $40 million to pay the dividend, and the rest, I believe, is going to go fully unhedged. And in fact, if I see any hedges, I'm very happy to call Paul and discuss as to what the plan is and share with anyone interested, because I definitely don't want that. We should be going fully unhedged. If we need enough hedges to pay the dividend and secure it, that's fine. But yeah, Surge definitely should not be hedging too many barrels into next year. Thoughts on Parex? Yeah, Parex is another one I don't really know much about, but their free cash flow is great, but the management is way too conservative. They got cash on the books, debt free. That's not what you want in a rising commodity price environment. You want debt because it amplifies the return of the shares. Debt free is not a positive. A lot of people are portraying it as a positive. It's a complete negative, in my opinion. So yeah, if you look at my portfolios, there's very few companies that are debt free or guiding towards paying off the debt, because every dollar in debt amplifies your return as a shareholder. And I think it's important to use your own portfolio risk tolerance and construction in that. But yeah, we've been going on for a while here, so I'll end it here. Thank you everyone again for joining. It's been really great. These macros, I really enjoy doing these macros because I think it gets the point across. They're very long, but the oil industry is a trillions of dollar industry. It's hard to understand it in a 30-minute session or a 45-minute session. And if I'm going to be doing the research anyway, I might as well share it and kind of go from there. And I got my email here or my phone. If anyone has questions, I'm always happy to chat. If there's any pushback, if there's any other data people want to share, always happy to chat. Any companies you want to bring up, you want to send them to me so I can look into them. I don't invest in American assets, so nothing in America, but anything in Canada, small startups, private stuff, anything, I'm always interested. And yeah, Twitter Spaces as well. Thanks for everyone who joined there. And once we end the recording here, I'll leave it to you. So hey, maybe continue the Twitter Space and deep. In the meantime, yeah, I hope everyone has a great weekend. A great, I think, inflection point has hit us in the last week on oil supply demand. And I look forward to see the new earnings and how people reconstruct their portfolios with these anti-energy stance who are just getting hammered in the broad markets. And yeah, look forward to a great summer ahead. It's actually interesting. I'm going to this conference in Vegas next week, and the CEO of Hemisphere Energy is going to be there. So I think some of these oil and gas companies are now marketing, are back marketing and feel comfortable attending these conferences and going to places. And, you know, it's just a little anecdotal things that really make me think, okay, this is a good trade, good investment moving forward. But yeah, thanks again. Hope everyone has a great weekend.